Assalamu alaikum friends, welcome to lecture 2 of taxation, and today's topic is on tax administration for individuals. How individuals have to pay tax, how it is paid on accounts, how the balancing amounts are paid, at what time of the year, the dates you have to be very specific with dates, and also the penalties and interest that you have to pay for the late tax payment or late tax return, whom to pay the tax. Okay, and in case of refund or overpayment or underpayment of tax, whom to claim. So all this administration process we are going to cover in this lecture. And make sure that you watch out my lecture 1 of taxation, because there I've introduced the taxation. Okay, and you can get it under my playlist taxation lecture. So this one, the first lecture and this second lecture are from your section A of syllabus. The third lecture onwards will be from section B, that is income tax for individuals. Now, so in this area, this is a big lecture because this is a very technical area. You have to remember lots of dates and all, okay? And mostly for multiple choice questions, your first section A section of your exam might test on this area heavily, okay? So personal tax administration. How do you assess the tax? Then how do you pay the tax? Interest and penalties. What is the percentage? Claims. Compliance check. How it is checked. Appeals. Penalties. The pay system and the key pay forms. So it has many areas to cover. We'll go one by one. Starting with an overview. So this is an overview for tax administration for the individuals only, because we have a separate one for company. Okay, it is more complex, and it will be explained later on when we start with companies. Now we are working on individuals only. So here, one is self-assessment, where you calculate your own tax. Taxpayers calculate their own tax. Next could be payee, that is pay as you earn. Anything that you receive immediately gets deducted from your income the moment you receive it. That's why it's known as pay as you earn. The moment you earn it, you have to pay it back. So it already gets deducted. We'll see what comes under payee. Okay. So for self-assessment, we assess our returns. That is time limit. Okay. For payment of tax and all, there is a time limit, and the time is fixed. Then we have compliance check, whether you have complied with the tax rules and all, and penalties. Then we have payment. So self-assessment, one, returns they will check. Next is the payment. Are you making the correct payment or not on the due date? Okay. Then are you paying the correct interest or not if you are paying late? And the penalties. If you are charged with penalties, that is also comes under payment. For pay, the forms of the pay you have to know, and also the system of pay. So starting with the collection of income tax. Okay. By the way, income tax will be our next topic. That will be continued from lecture 3 onwards. Okay. Because as I told you in my when I introduced the taxation syllabus, I told you there are different types of tax on your income, that is income tax, corporation tax, inheritance tax, capital gain tax, VAT. We are going to cover all these different types, starting with income tax because this is the easiest. But let me tell you, even though income tax is the easiest, it is in terms of syllabus and chapters. If you see in your textbook, it is the biggest portion is income tax, because income tax has many types of income: self-employed income, employed income, other earned income. It has from different areas when we have to cover all this area. Okay, but other tax are less extensive in terms of chapters and syllabus. That is, in terms of syllabus, it's like you can say 20-30%, but income tax alone takes 40-50% of your syllabus. Okay, so be very careful when you're doing calculation on income tax, and learn the rules as fast as you can. Okay, because income tax also has a very high chance. Okay, income tax is asked in your section C. of your taxation exam paper. Discussion questions and all. Income tax will be tested there. So now all employees, okay, in UK, employees have their income tax, okay. Like I'm residing in Oman. Okay, so in Oman, we don't have any income tax. We don't have to pay any tax on our income. The only taxes we have to pay, one is indirect tax, that is VAT, that have just been introduced from 2021 April, 16th of April, and also the tax on the company profit, that is 15%. Only these two tax, no income tax. But in UK, every employee have to pay the income tax, and also in addition to that, they have to pay National Insurance Contribution, NIC. Okay, later we are going to cover in depth NIC. There are different types of NIC, by the way. There are different classes of it. Okay, and how do you pay differs. But in UK, every employee pay tax on their income as well as NIC. Every resident in UK has to pay it. National Insurance Contribution. Whether you are self-employed, whether you are employed, whether you are an employer, you have to pay NIC. Okay, so you can see it could be your employment income, self-employment income, any type of income, even the company profits, you have to pay NIC. Okay, and in some cases small amounts of other income also will be there, tax will be there, so collected at source through the pay system. Now self-assessment is the system for the collection of tax which is not deducted through the pay system. You don't deduct that. Okay, then therefore employees with more complicated tax affairs and other taxpayers, for example self-employed, okay, what will they do? They are normally required to submit details of their taxable income and gain annually in a tax return so that their tax liability can be calculated and collected through the self-assessment system. So they will submit all this, then they will calculate the tax liability for self-employed people. Now self-assessment, what is this self-assessment? So under self-assessment means you are assessing your own tax. Okay, everyone will be calculating their own tax liability. So owner has to provide, the taxpayer has to provide the information. Okay, we'll see what is this information. First, taxpayer will send a notice to complete a self-assessment tax return annually. This is how it starts, the process. First, every taxpayer has to send a notice that they are going to complete a self-assessment tax return annually. It is done. Then a return must be completed and filed. It could be on paper or electronic. Then there are different deadlines, one for paper, one for electronic. Third, tax return covers income tax, class 2, class 4 NIC and CGT, capital gain tax liabilities for the year. Okay. I will explain you what this class 2, class 4 NIC is in a short span of time. Okay, just after a few minutes I'll be explaining you NICs. When we go to the payment on account, here I'm going to explain you the NICs, the next topic under this lecture. Now payment of the tax, you need to memorize this, by the way. Okay, in your tax return, what are the types of tax that is covered, because when you finish taxation you must have studied all the types of tax, right? That's why it's very important that you have to memorize some things. There are a lot of things that needs to be by hearted in taxation, because it's very rule based. Taxation is a very rule based subject, unlike your audit or your other papers, financial management or performance management, right? And payment of the tax, remember this always, payment of the tax must be made by 31st January following the end of the tax year to which it relates. And I'm sure that by now every one of you should know when is the end of the tax year for 2020 to 23. I've covered it in my first lecture, or even my when I've introduced the syllabus of taxation, I've covered that. In case you don't know, let me tell you, the end of the tax year for FY 2022, that which we are doing right now, is end of the tax year is when 5th of April 2023. So 31st, following the end of the tax year, 31st, it should be 31st January 2024. So that means tax has to be paid by 31st Jan 2024. Okay, I've covered the end of the tax year and also the starting of the tax year for 2022-23. Okay, it is from 6th April to 5th April. Now, interim payments on account. Payments on account means some we pay in installments. Okay, some taxes are there that we pay installments, payment on account, which we'll cover a little bit later. So even this payment on account, for what? For income tax and class 4 NIC may be required on 31st Jan and 31st July following the tax year. Everything is following the tax year only. After the tax year only it comes. That means 31st Jan 2024 and 31st July 2024. This is for certain taxpayers, okay? Not all. Especially for the ones who are paying on account. Some tax you cannot pay on account. We'll see that later. Some taxes, yes. Like income tax, class 4 NIC, yes. We pay on income on, we pay on accounts, and there's a choice, 31st Jan or 31st July. But after the end of the tax year. It should be following the tax year. That means the next year. Take the end of the tax year and the next year of it, 31st Jan and 31st July. Now, filing deadline. So as I told you, the deadline for submitting return is, this is for deadline, okay? This is not for payment of tax or payment on account. That's why it's not 31st Jan or July. It is for deadline. Deadline is 31st October 2023 for a paper return. And for electronic, it is 31st Jan 2024. That means for online return, they are giving you more time compared to paper return. Now, or if later, 3 months after HMRC issues a formal notice requiring completion of tax return. Let's say they have issued, HMRC have issued a formal notice that they require completion of tax return. So 3 months from that also could be your deadline for submitting the return. So the 31st Jan following the end of the tax year is known as the filing date. Remember this. Okay, whenever question asks you what is the filing date, it is 31st Jan following the end of the tax year, regardless of whether the return was on paper or electronic. It is 31st Jan only. Yes, you can submit, like the deadline is different, but filing date is 31st Jan. This must be distinguished from the date on which a return is actually filed or submitted, which is the actual filing date. Yes, 31st Jan is a filing date, but you might actually pay later. So whenever you pay later, that is known as actual filing date. Okay. Now the content of the tax return. You should know this, especially if you are planning to work in the tax department or not. So this is how a tax return will look like. Okay. So the taxpayer completes the main tax return form, that is SA 100. So where they'll be giving basic details like the taxpayer's name, the address, and certain types of investment income. Then there are some supplementary pages that taxpayer has to complete, which tells HMRC that these are the taxpayer's income, these are their gains, and also income from employment, income from property, capital gain will be included there. Then if taxpayer is having completing the tax return online, supplementary pages can be added online if it's necessary. And if it's a paper, okay, then you need to request for the supplementary pages. Okay, they should be requested at the same time as the main paper tax return. The moment you are taking the main paper tax return, same time request the supplementary pages also. Okay, now for self-employed people it will be different, for employed people it will be different, from an employee it will be different. Okay, for self-employed people they should complete the self-employment supplementary pages, and for employees they generally pay their tax liability under payee only. For employees normally it is deducted only, and whatever they get is after deduction of their tax from their income, whatever the income they get, net income. Okay, so for employees often self-assessment tax return is not required for them because it is deducted, and also there's no further tax liability also for employees. But if they receive other taxable income, sometimes it's possible that employee might receive taxable income other than that employment. Okay, and it might not have been deducted through pay system, then they have to complete a tax return. Okay, because even though like you are aware of it, employees is aware, self-employed people might not be aware, I mean your employer might not be aware of it. You might have got that taxable income from some other source. You have to complete a tax return for that taxable income, not from your salary that you receive from your employer. Partnership, for partners they are dealt individually. Okay, so each individual partners have to do their own self-assessment. So there you have to give details of the partner. Then it includes a partnership statement detailing the partner's tax adjusted trading profit and shows how tax adjusted profit is allocated among the partners. Return, calculation of tax. If it's electronically, the return is filed. Okay, automatically tax liability is calculated. Okay, so calculation of tax liability is automatically provided as part of the online filing process. If it's a paper return, okay, then HMRC will calculate the tax liability on behalf of the taxpayer, provided the return is submitted by 31st October deadline. That is their deadline, no? But taxpayer also has the option of calculating the tax instead of HMRC. They have that option. Now, the calculation of it by HMRC is treated as a self-assessment on behalf of the taxpayer. If HMRC is the one who is doing the calculation, still it is taken as if the taxpayer has done self-assessment. He have calculated his own tax. Okay. Now, where HMRC calculates the tax, remember, it makes no judgment of the accuracy of the figure included in the return, but merely calculates the tax liability based on the information submitted. That means if you make if any of your figures that you have calculated was incorrect and you submit it to HMRC to calculate your tax, remember, HMRC will not check the accuracy of your figure. They will just roughly calculate tax liability based on whatever information you have submitted. So you might have submitted them an incorrect information also. Based on that only they will calculate the tax liability. Okay, they will only calculate the tax liability. They will not see that the figures on which they are calculating that tax, whether those figures are accurate or not. They will not see that. So HMRC normally communicates with the taxpayer by issuing a statement of account, which is a remainder of the amounts owing to HMRC. This is how they communicate. So in that statement of account, any amounts that is owing to HMRC, HMRC will give a remainder to the taxpayer through that statement of account. So taxpayer will know that this is how much they are owing to HMRC. Until they don't clear off their account, taxpayer are not free. You cannot ignore this. Even though you are doing a self-assessment and all, you cannot ignore HMRC. You have to pay their amount. Now, statement of account. Here, tax charges will be there. Any interest or penalties will be there. Any payment already made by the taxpayer will be there. so that you know just the outstanding balance. Now, amendments to the return. Yes, it's possible that all the time return might not be accurate. Sometimes you have to change the return. And this one, any party can do that amendment. HMRC can do that. But if HMRC does it, rules are different. If you do it, time limit will be different. We'll start with HMRC. Okay. HMRC can correct any type of mistakes or error if they've discovered anything within 9 months of the day the return is filed with them. Within 9 months, you have to remember this time, by the way. It will not be given to you on an exam sheet and all. Only tax rates and all are given. Okay, for example, this is the tax rate at basic income level. This is at higher level, additional level. Only those things are there. Tax rates are there, but not this 9 months. They will not give you all this months and all. Dates and all you have to remember. Okay, you have to buy hard it. And there's no shortcut to it. Okay. So, HMRC within 9 months of the date, the return is filed with them. It could be any type of error, arithmetical error or errors of principle also. Okay. Now, if it's taxpayer, they are given more time. Why? Because HMRC are more specialized and also they are given, we can say, based on that logic if you want, why HMRC is given less time, why you are given more time, because you are more prone to make mistakes than HMRC. No? HMRC has been collecting tax from, giving refund, collecting tax for with so many people. So they're more specialized. They're less prone to make mistakes than you do. That's why more time is given to you based on that. So taxpayer can amend the return within 12 months of the 31st Jan filing date. They have given in the date also, in case you're not understanding that 12 month 31st Jan. So when is the filing date? 31st Jan filing date is 31st Jan 2024. Just now we went through that few slides back. So 31st Jan 2024 is the filing date. We don't care when is actual and all, that is the filing date. So if you take 12 months from that date, 31st Jan 2025. By this date, amendment has to be made by you, taxpayer. You means I'm always referring to the taxpayer. Okay. Even the amendment deadline is same regardless of whether return was paper or electronic. Remember, amendment deadline is same. It could be on paper, it could be electronic. Now, if an error is discovered at a later date, then the taxpayer can make a claim for an overpayment relief to recover any tax overpaid. Let's say they have paid more tax and they have discovered an error, and because of that error they have paid more. So now they want that tax back. Those extra that they have paid, they want it back. Taxpayer can make a claim. Okay, he has that option. Now, notification of chargeability. You have to notify HMRC that yes, you are chargeable to tax. Sometimes some individuals might not have to pay any tax at all, 0% tax. So only those people who have to pay the tax have to have this notification of chargeability. They have to notify HMRC. Otherwise, you don't have to worry about it if you have no tax to pay. Okay, so this responsibility lies with the taxpayer. Taxpayer have to notify HMRC of all their taxable income. Therefore, taxpayers who do not receive a file to file a return are required to notify HMRC if they have an income or chargeable gain on which tax is due. In case you don't receive it from HMRC, a notice to file a return, you have to still ask HMRC to give you. If you know you have an income or chargeable gain on which you have to pay tax, it's your duty, responsibility. So don't entirely leave the responsibility to HMRC saying that because I didn't get a notice to file a return, I can avoid tax, I should not pay tax. You have to pay a very huge penalty for it with interest. Because remember, in UK, not even in UK, worldwide, wherever tax system is very strong, they are very strict about taxation. They're very strict because tax is a huge expense for them. I mean, it's a huge amount of revenue that governments collect in UK, HMRC. So they're not going to leave you. So don't think you can ignore. Even if you have not notified, even if you are doing self-assessment, HMRC will catch you eventually. Okay. Next, time limit for notifying HMRC of chargeability. What is that time limit that you have to notify HMRC? That you have to pay tax 6 months from the end of the tax year. Everything starts from the end of the tax year only. See, there's a difference. Please understand the wordings. If you see some time limit, they say that X number of months, let's say 3 months. 3 months, or okay, let's say 12 months. 12 months following the end of the tax year and 12 months from the end of the tax year. There's a difference between those two. The first one is, if you see the word following, it's always the next year than the tax year, end of the tax year. For example, tax year is year end is, okay, 5th April 2023 for this year. So 5th April 2023, okay. If it says following, following means it will be 2024, the next year. But if it says from the end of the tax year, means the same year only. You just have to calculate. For example, if this was the other way around, 6 months from the 6 months following the end of the tax year, then the date will be 5 October 2024. But here they don't have the word following. That means just 6 months from the end of the tax year. That's why the date is 5 October 2023. Words are very important. You have to see whether the word following is there or not. If it's following, next year. If it's not following, the same year, but after the end of the tax year. So that's how you decide. Okay. So by 5 October 2023, you have to notify that you are chargeable for tax. And notification, remember, it is not necessary if there is no actual tax liability. How can you say that? You might be thinking that I'm having so income, why should I not pay tax? Because we have also covered in the first lecture. If you have not watched my first lecture, okay, please go and watch it out. Otherwise you will not understand. You will have little difficulty in lecture 2, because there I have showed you the income tax rates, how it is calculated, what are the allowances, what are the exemptions. I have covered it there. Most of it are covered in my lecture 1. So do watch it out. And so for example, if the income or the capital gain is covered by allowances or exemptions, they also give you so many allowances and exemptions. We have personal allowance. Yes, 12,570 for this year. Then we have capital gain allowances, which we have not covered yet. But when we go through capital gain, yes, we'll go through the allowances and exemptions. But so many exemptions are there. Loss relief is there, other things are there. So all this sometimes might reduce your income to 0. So then you don't have to pay tax. Then you don't have to notify HMRC also. So all this headache comes when you actually have a income on which you have to pay tax. If you don't have to pay any tax, no headache, nothing to worry. You have nothing to do with HMRC. Okay. Now, a standard penalty may arise for failure to notify chargeability. If you fail to notify, then there's a standard penalty. And what is this penalty? Penalty is also different. Penalty if you're paying late, penalty if you're submitting the late return. So first we'll go through the failure for penalty for failure to submit a return. Okay. For this, HMRC has imposed fixed penalties. Okay, and it is dependent on the length of the delay. The more the delay, the more the penalty. Now, determination of tax due if no return is filed. How do you determine the tax if no return is filed? HMRC is going to determine that amount of tax due. Okay, if you as a taxpayer has not filed your self-assessment tax return by the filing date, HMRC is going to determine that tax due. I told you they are not going to leave you. You cannot say I have not completed my tax return, therefore I don't know what is the correct amount of tax, therefore I'm not going to pay tax. No. HMRC is going to determine that amount of tax due. So the impact of this will be, the determination is treated as a self-assessment of the taxpayer. I told you, even if HMRC is doing it for you, It will be taken as you are doing that self-assessment. And the determination can only be replaced by the actual self-assessment when it is submitted by the taxpayer. The submission of a tax return. Okay. So let's say this determination, okay, that HMRC is going to pay the tax, right? So that you can replace. How? HMRC should not will not determine your amount of tax due. How you can replace it? Only when you have submitted the tax return. When you have actually submitted the tax return, then HMRC will not determine your amount of tax due. Because then an actual self-assessment is done, no? By you, by paying the tax return. Now, for this, there is no appeal. You cannot appeal that why HMRC is going to determine your amount of tax due. You have no help in that area. So, in short, HMRC is encouraging you to pay the tax return, to submit the tax return. Okay. And this determination can be at any time within 3 years of the filing date. Please remember when is the filing date. Always remember when is the filing date. 31st Jan 2024. So if you take 3 years, add 3 years with it, becomes 31st Jan 2027. Okay, that's why. So within the 3 years, determination can be made at any time. Records. For records, rules are different. Okay, that also records for different types. Employees will have different records. One with a business will have a different record. So taxpayers with a business. Okay, let's say you have a business, letting of property. What type of records you have to keep? Number 1, all receipt and expenses. Number 2, all goods purchased and sold. Number 3, all supporting documents relating to the transaction of the business, such as accounts, book, contracts, voucher, receipts. And if you have a business, you are known as self-employed. Okay, so for self-employed, okay, records has to be kept for 5 years after the 31st Jan filing date. When is the filing date? 31st Jan 2024. So if you had 5 years from that, will be 31st Jan 2029. Until then you have to keep. For 5 years, records has to be kept. Next. Yes, I told you. So 31st Jan 2029, you have to retain all the records. Coming to other taxpayers. Okay. For other taxpayers, records will be less. But still they should keep some evidence of income received, such as dividend vouchers, P60s, copies of P11Ds. When we go through the PAYE form, you will understand what this P60, P11D means. Okay. For now, just ignore it. I mean, just remember it, but don't think too much. And bank statement. The record for this taxpayers have to be written until the later of this two. First, whichever is later, until then you have to retain. That means longer you retain, better it is for you. 12 months after the 31st Jan filing date. That means 31st Jan 2025. And date on which compliance check into the return is completed. We have not covered yet compliance check. Sometimes HMRC does that, whether you have complied with the rules or not. They do it that check. Not all the time. When they're suspicious of some kind of activity which might not be very reasonable. Okay, that time only. So either when the compliance check is completed or 31st Jan 2025, whichever of these two is later, until then taxpayers have to retain the information. Why is that? See, think logically. If they would have made 12 months after 31st Jan filing date only, unlike business, sometimes they might have to do some types of compliance checks and all. So if you don't keep it till the compliance check and only keep it till 31st Jan 2025, maybe compliance might be done after that. Then they might not have any records, no? That's why they need that record. That's why they are telling later of this too. Until the compliance check is done or 31st Jan 2025. Whichever is later. If no compliance check is done, then till 31st Jan 2025, keep it, and then it's not required. Now, oh yes, there another one. The date on which it becomes impossible for a compliance check to be started. Whichever of these three is latest. Records. Now, penalty for not keeping the records. Here, again, you will be charged a penalty. Okay. In most serious cases, only maximum penalty will be charged on you, such as where taxpayer deliberately destroys the records so that they can mislead the HMRC. I mean, if HMRC announces that they want to do a compliance check, in order to prevent them from doing that compliance check, sometimes taxpayer deliberately destroys the records. That is a serious case and serious penalty. Maximum penalty you have to pay. Now we are moving on to payment of tax. So we are over with personal tax administration, all penalties and all. Coming to payment of tax. Now you should know how to pay the payment of tax, because before I start, okay, even in your syllabus it says this is how they have followed. First they finished all the tax administration, how tax is paid, what interest, penalty you have to pay. Then they will start with the types of tax, different types of tax, how it works. Okay, now taxpayer is required to settle liabilities by 31st Jan following the end of the tax year. Tell me the date without looking. 31st Jan 2020, 24 is the date. So income tax, okay, you have to pay this tax by 31st Jan 2024. What are those tax? Remember it. Income tax, class 2 NIC, class 4 NIC, CGT. By 31st Jan 2024. I told you I'm going to tell you what this NICs mean. Okay. So what is this class 2, class 4 NIC? I'm sure some of you might have even Googled it also. Okay. But in case you haven't Googled it, let me tell you very briefly, because later on when I'm going to income tax, I'm also going to cover NICs later on in depth. But for now, briefly understand what this classes means, because I know you have that curious mind and you'll be worrying what is it, okay? So basically in UK, your national insurance contributions are divided into different classes, okay? There are total 5 classes, okay? 5 classes. Class 1, employee, class 1, employer, class 1A, class 2 and class 4, okay? The reason they have mentioned only class 2 and class 4 is because only this we are paying by 31st Jan 2024. They have not mentioned all the NICs. That will be covered when we go through NICs later on. So class 1 is divided into 2 parts, one for employer, one for employee, okay? They have given that quantitative threshold and all. Limit is there, percentages are there, okay? So there is a percentage that is based on the employee's earnings and also in excess of certain limit that they have to pay. So class 1 employee, employee is paid. Class 1 employer, employer pays it for that employee. Next, class 1A. Class 1A is paid by employer, but it is paid for any types of employment benefits in kind. Benefits in kind means it's not cash. For example, if you're using company car, if you're using any sort of facilities from your company, employees are using it provided by the company cars or medical facility or health facility or a car, anything, benefits in kind, it's not in cash. For that also you have to pay tax. An employer pays that tax. That is known as class 1A. Then we have class 2. Class 2 and 4 are for self-employed. Okay. Class 2 is a flat rate weekly contribution. It's a fixed rate. Okay, weekly you have to pay. It's a flat rate. Rate is decided flat rate weekly. That means into 52 weeks. Some rate is given into 52 weeks. For now, you don't have to know what is that rate and all. because when we cover NIC, you will eventually know it. And class 4 again is the same, based on your tax adjusted trading profit. You have to pay a percentage if it's beyond that level, beyond a certain level, on tax adjusted trading profit. That is for class 4. So that's why we have mentioned class 2 and class 4, because they are paid by self-employed people. Unlike others are paid by employer and employee, employer and employee. Yes, if anything is paid by employee, that is automatically deducted from pay as you earn, payee. Okay, for that we don't have to wait till 31st Jan 2024 to pay. That's why we have not mentioned it. That's why we have already mentioned class 2 and class 4, because they are paid by self-employed, and self-employed pays not on pay as you earn basis. They have to do self-assessment. They have to calculate their own tax and then they have to pay. Understand? So that's why, and same for income tax, same for capital gain tax. Okay. So now, payment on account. This is you are paying on installment. Okay. Only certain taxpayers have to pay on account. Okay. So here, if a taxpayer had an income tax liability in the previous tax year in excess of any tax deducted at source. Let's say you have deducted some tax at source, but you have more tax than that in the previous year. A payment on account is normally required for the following year. Not understanding? Okay, don't worry. For now, keep it. We have some calculations to do. The moment we do the calculation, I will show you. You will understand this, okay? Some amount of the previous year you have to pay this year, and some amount of this year you have to pay the next year. That's how it works. That means 50% this year, 50% next year. That's how payment on account works on installments. There are exceptions to this, by the way. Exceptions are, if your total tax liability, please understand whatever is in bracket, you have to remember it. Total tax liability means income tax plus class 4 NIC and less payee for the previous tax year. We are talking from the previous tax year, okay? Less payee is less than 1000. Income tax plus class 4 NIC minus payee. If it's less than 1000, you don't have to pay on account if it's less than 1000. And second exception is more than 80% of the total tax liability. It says or. Please always see whenever conditions are attached, whether it's an and condition or a or condition. If it's and, both of them has to be satisfied. If it's or, if even if one is satisfied, exceptions is there. So it says or. More than 80%, that means you have to check both. More than 80% of the total tax liability. Here, total tax liability means income tax plus class 4 NIC for the previous tax year. Don't ask me why class 4 NIC, why not class 2, class 1 NIC. Don't ask me that such questions. It is fixed by HMRC, so we'll go by the rule. I told you it's rule based. This paper is a rule based paper. Whatever rule is given, laid by them, we have to just follow. Okay. So income tax plus class 4 NIC is your total tax liability. You have to see whether more than 80% of that for the previous tax year was met by deduction of tax at source. If you are not understanding, we'll keep it here. Don't worry. We have calculations to do. We have lots of calculations in this lecture actually. And the impact of those provision is that most employed people will not have to make payment on account. What does this mean? This means if you are an employee, you don't have to worry about this payment on account. This is mostly for self-employed people because they have lots of income, no? They have a huge amount of revenue. Their taxable total profit is huge, for which they have to pay amount of tax, right? It's for them. Because for employees, if you see, more than 80% of their tax liability is usually paid through payee. That's why they don't have to pay. So one exception they have met for employees. Now, what is the due date? Yes, even for payment on account, due dates are there. The due date is first payment on an account. First installment will be 31st Jan 2023, even before the end of the tax year. tax year is 5th April 2023, right? Before that you have to pay. Next one is 31st July 2023, after the tax year end. Any remaining liability is then settled on the balancing payment date. Whatever the balance will be on a fixed date, that is known as balancing payment date, 31st Jan 2024. So 31st Jan, so Jan, July, Jan. Okay, Jan, July, Jan. Remember this. Now, self-assessment payment on account are only required for income tax, class 4 NIC, only this two. So calculations of payment on account should not include any amount in respect of CGT or class 2 NIC. Are you understanding? There is a separate CGT payment on account obligation. For payment on CGT, we have a separate payment on account obligation, which we are not going to cover here. Why? This topic is for individual tax administration for individuals only. Like we are focusing on income tax or not. So calculations of this. So payment on account are calculated using the previous tax year's relevant amount. We have to calculate an amount called relevant account, and it comes from the previous tax year. Okay, we have to calculate it because our payment on account is based on that. So therefore, the payment on account for 2022-23 will be based on the relevant amount for FA 2021. That means 2021-22 tax year. You have to take the relevant amount. This is how it is calculated. Total tax liability, class 4 NIC plus income tax, less PAYE, relevant amount. This much you remember? Now, if there is no relevant amount from the previous year, what do? No payment on accounts. No payment on accounts. Sometimes it's possible. For example, let's say a taxpayer has started a business from 1st of May 2022. 1st of May 2022. So there will be no relevant amount from the tax year 2021-22 because tax year 2021-22 ends on 5th April 2022, but he have started after that tax year, so he does not have the previous year's relevant amount. Okay, so for 2022-23, no payment on account because last year there's no relevant amount. You understanding? So you have to always check the date. Now, this is the first question on payment on accounts. We'll go through it and we'll solve it. There are lots of questions, but let's go through it. Obviously, in your exam, you will not be asked such an easy question, but since this is just an introduction, we'll slowly increase the level of difficulty as we progress along the questions. So, Roderick is required to make payments on account for his tax liability for the tax year 2022-23. In the previous year, his tax liability was 5,100. Of this, 1,250 was collected via PAYE. One condition is it's more than 1,000. So you know he has to pay tax. We'll check out whether it's 80%, more than 80% or not. More than 80% has been deducted through PAYE or not. So what is the relevant amount? See, you have to deduct PAYE from the tax liability. That is 5,100 minus 1,250. Relevant amount is 3,850. If you check, you have to calculate a payment on account. Always first decide whether payment on account is required or not. If it's not required, then don't calculate. First, you have to check the 1,000 and the 20% limit. If it is satisfied, you have to calculate. If it is not satisfied, no payment on account. So if you see, the relevant amount exists more 1,000. 3,850 is more than 1,000. First condition satisfied. What about second? More than 80% is deducted. So to know that 80% of it has been deducted or not, just take 20% of the total tax liability. That means 20% has been deducted. So if you take 20%, what is the total tax liability? Without taking PAYE, okay, on 5,100, not on the relevant amount. which is 5,100. If you take 20% of 5,100, it is 1,020. But if you see, your relevant amount is 3,850. I mean, if sorry, your pay is 1,250. It is more than the 20% of that amount, 1,020. Okay, if it's more than 1,020, payment on account is required. If you say your pay as you earn, it is 1,250, which is more than 1,020. So more than 20% of the total tax liability has been deducted as pay. Now do you understand that 80% rule? That's why payment on accounts are required. So this is how you calculate. It is equal division. Okay, equal. It's a rule. They have given it right now. Okay. On the relevant amount. So relevant amount is 3,850. Take half of it, 19,250. So 19,25 will be paid on 2 dates. What are the 2 dates? 31st Jan 2023. The other one 31st July 2023. Do they have any more balance to pay on 31st Jan 2024? No balancing payment. Now we'll go through another question. Test your understanding one. Go through it. Pay is 2,100, income tax 9,400, class 2, class 4 CGT. Remember, when you are taking, you are only taking income tax and class 4 NIC. You are not taking class 2 and CGT. So ignore this two. Now calculate how much pay on account. Before that, decide whether it's more than 1,000, whether more than 20% has been deducted as pay you as you earn. So we'll do that. So relevant amount is your income tax 7,300 plus class 4 NIC 700. Only class 4 you are adding. And if you say it's 8,000 and it exists more than 1,000. Also take 20% on 7,000. See, when you are taking total tax liability, okay, you are taking class 4 NIC and your income tax before deducting pay. See here, you have taken 7,300 after deducting pay, that is your total tax liability. Then you have added 700, that is class 4 NIC, to find relevant amount. But when you want to find whether 20% has been deducted, you are taking income tax only without deducting pay, 9,400. So 9,400 plus 700, that is class 4 NIC. Take 20%. It is 20,020. So 20,020. If you see, more than 20,020 has been deducted as pay as you earn from your previous slide. That means more than 20% of total tax liability has been deducted as pay. So payment on account are required. So take half of it, half of a relevant amount. That means 4,000. 4,000 31st Jan 2023, 4,000 31st July 2023. So capital gain take class 2 NIC, no payment on accounts are required, so we ignore them. You always have to understand in taxation, also you have to understand what to ignore and what to take. Sometimes they will give you everything. You should not take everything because it is given for the sake of doing something with it. I have known students who will take capital gain tax in class 2 NICs also. Or they might take class 2 NIC because they get confused between the classes. So understand and remember it's class 4 NIC only. And income tax. These two are relevant when we are talking about payment on account. Okay. Now we are moving on to claim to reduce payment on account. Sometimes we can reduce the payment on account, but we have to make a claim for it. But on reasonable grounds, not just whenever you feel like. Okay. You have to prove it also, why you are claiming it. So a taxpayer, that T is by mistake, okay? Ta, it's not ta, it's a taxpayer. So just ignore the T. A taxpayer can claim to reduce at any time before 31st Jan following the tax year. That means before 31st Jan 2024, anytime he can make the claim. Why did I say 31st Jan following the tax year? Please understand. Your last installment you are paying is by 31st Jan following the tax year only as a balancing payment. 31st Jan 2023, 31st July 2023, 31st Jan 2024. That is your last payment as a balancing payment. So before that last installment, you can make claim anytime to reduce your payment on account. Under what condition? If you expect your actual income tax and class 4 NIC net of PAYE, okay, after deducting PAYE, to be lower than for this year to be lower than the last tax year. You expect, you are estimating, you have not actually calculated it, right? So you're actually, you are expecting this year it will be less than the previous year. Then you can claim for reduction in payment on account. Okay, so as I told you, you have to state the ground for making the claim. They will check into it. So following a claim, once a claim has been done, after that, if it's effective, your payment on account will be reduced. And then what do you have to pay? Each payment on account will be for half the reduced amount. Whatever amount is reduced, half of it will be your payment on account. Okay, unless the taxpayer claims that there is no tax liability at all. If it's no tax liability, no pay on account. If payment on account based on the prior year figure are paid before the claim, sometimes it happens now you might make the claim later on to reduce the pay on account, but you have already paid it. You have paid you have paid more as a payment on account based on the previous year figure before you made the claim to reduce. Then whatever you have paid extra for that overpayment, HMRC will refund you back. Okay. Now, sometimes incorrect claims also could be made to reduce payment on account. So incorrect payment claim means, what is incorrect claim? Remember, taxpayer should only claim to reduce if their tax liability net of pay after deducting payee for the current year is expected to be less than the payment on account based on the previous year's relevant amount. If it is the other way around, let's say your actual tax liability is more than the previous year, then what happens? And you have made the claim to reduce, then it's an incorrect claim, right? So if it's an incorrect claim, this will be the consequence. Number one, interest will be charged on the tax underpaid because you made a claim, you paid less payment on account. But in fact, it turned out that your actual tax liability is more than, because you are estimating a reduction in actual tax liability, but it turned out to be more. And because you have made a claim for a payment on account, you have paid less. So interest will be charged on the tax underpaid. Next, also a penalty may be charged if taxpayer fraudulently or negligently claims to reduce. Sometimes it happens. It could be a fraud, or you could be very negligent. You are simply claiming reduction in payment on account. Penalty will be charged. But if it's an error, just a simple error, penalties will not be, you will not be charged with a penalty. Understand the purpose of HMRC is simply to penalize taxpayers who claim large reductions in payment on account without having any reasonable ground to claim. That's it. Their purpose is not to charge penalty to each and everyone. If it's an error, then no penalty. Now comes the balancing payment. After we have paid 31st Jan 2023, 31st July 2023, we have another installment to be made on 31st Jan 2024. That is known as balancing payment. Okay, this is how it is calculated. Total tax liability for the year. Now take class 2 NIC and CGT also. Here you need, for the balancing payment unit, payment on account, you note balancing payment you need. So I told you, even though in payment on account they didn't catch you, in the balancing payment they will catch you. So in short, whatever tax you have to pay, whether early or late. right? So here you are taking the total tax liability is calculated how? Income tax plus class 2 NIC plus class 4 NIC plus CGD. Okay. Less payee, less payment on account, whatever payment on account, earlier installment deduct. Balance is known as balancing payment. Now, sometimes, okay, balancing repayment will be due. Sometimes you might have paid more in a balancing payment. So if you have paid more, HMRC will refund you that payment also. Okay. So any amount you have overpaid, HMRC will repay that. Okay. That's a good thing. Where the amount of tax due changes as a result of amendment to a self-assessment, either by HMRC or by you, any additional tax due must be paid within 30 days of the notice of amendment if this is later than the normal due date. Usually from the normal due date we take 30 days, but if notice of amendment is later than the normal due date, then that 30 days comes from that notice of amendment only, not from the normal due date. Then later of the normal due date, from that date onwards, any date, you have to take 30 days. Within that 30 days, additional tax you have to pay. See, whenever they say 30 days, you have to be very strict. It has to be 30 days. You cannot take 31 days also. Sometimes students often take 30 days as 1 month. They might say 1 month. Don't use it. 1 month and 30 days are very different. Yes, in a month there is 30 days, but in a month there is also 31 days. Some month has 31 days. So if they say 30 days, it is 30 days only. If they say 30 days from 30th June, so the payment has to be by 30th July, not 31st July, not the end of the month. Because 1 day extra you pay late, for that 1 day extra you have to pay interest. That's how much strict they are on the correct payment date. Okay, so be very strict with the date. If it's 30 days, you have to count exactly 30 days, not 31 days also. Even if it looks like it's just a month, not a big deal. It's a big deal for them. And also going to be a big deal for you on the exam if they cut the marks. Okay. And I don't want to be losing even 1 mark. Silly mistakes. Okay. Avoid it. So now we'll be doing some questions on the balancing payment. So here we have two questions, illustration 2 and test your understanding 2. Similar questions will do to see a pattern. Okay, it's always good to do more than one question on any given topic until you don't see a trend or a pattern. Okay, so first question, from continuing the example from Roderick, that was illustration 1. You have now known that the final liability is this much. Okay, of this amount, this much has been collected. Now, what is the total amount to be paid by 31st Jan 2024? That is the question. And if you see test your understanding 2, similar question. Okay, payment on account was this much. You have to identify the balancing payment due and also state the payment date for both. Okay, you should know. This is why I tell you, you should know the date as well. Just knowing the payment is not enough. Just knowing the calculation, not enough. So we'll start with illustration 2. In case you don't remember, you can always make sure that you have the soft copy with you so that you can always go back to illustration 1 to see the figure. In case you don't have it, you can go back to my video and go to illustration 1, take a screenshot and take the figure down. And later on, you can get the textbook and the kit from my channel itself. The link is given on my channel on my about section. Go and download from ACCA material. Okay, the link ACCA material, click there and get the both ATX and taxation textbook and kit. Now, coming back to illustration 2. So here, the balancing payment. Okay, Here they say 31st Jan 2024, right? Now, question says state the total amount payable by on this date only. This date could compromise many elements. And what payment relates to. You have to tell each payment what it comes from. Either is it payment from account or balancing payment. Okay. So, for 31st Jan 2024, it compromises two things. First thing is the balancing payment for tax year 2022-23. Why 2022-23? Because balancing payment is always made following the end of the tax year. 31st Jan following the end of the tax year. End of the tax year is, I will write end of tax year here, 5th April 2023. So end of tax year, following the end of the tax year, 2024 Jan. Okay. Next is the first payment on account, but for a different tax year. For the tax year 2023-24. Why? Because 31st Jan 2023, you see the date? Payment on account is made before the tax year, end of tax year. By 31st Jan, before the end of the tax year. So 31st Jan 2023. So two things are there. Okay. So whenever they tell you, always write. You have to write also. Just calculating and finding balance on payment, anyone can do it. Just finding payment on account, anyone can do it. But you have to clearly label. Often students don't do this and miss a lot of marks because it is not clear to the examiner what are you actually saying. Sometimes they include both the figure. They don't even write whether it's a balancing payment or a payment on account. So first we'll solve the balancing payment part. Okay. How are we calculating balancing payment? Write it. I'm going to write short form balancing payment for the tax year. Whenever you're dealing with in taxation and ATX, write the tax year. How in SBR we write IFRS label under this IFRS for tax year is important. Okay. For the tax year, and this is how we write tax year 2022-23 is based on the final liability. That is final installment. For the tax year, which tax year? 2020-23. Okay. Sorry. Yeah, 2022-23. Less PAYE. And the payment on accounts already made. Please understand, when you're finding the balance in payment, you deduct your tax liability from the payee from the payment on account already made. For which year? 22-23. Okay. Now, we'll find out. Okay. We'll do that. So now we'll do the calculation. Income tax liability. What is the income tax liability? 7629, this figure. And payment is 1635. And balance on account we have already found in illustration 1. So you need to go and check back. 7629 less payee, which is in this question 1635, less payment on account. It is the payment on account. Okay, that is this 3850 and 2144. This is the balancing payment, BP. You don't write BP, I'm using it just in order to save time. Okay, now once balancing done, now what about the first payment on account? Now balancing payment is over. For now, keep it. The first payment on account for 2023-24 will be 50% of the relevant amount. Payment on account is always on relevant amount. 50% for the previous tax year. So here also income tax liability 7629, this will be same. Deduct pay, this also will be same. 1635 and it becomes 5994. This is your relevant amount, RA. So you have to take half of relevant amount. First payment on account is half of 5994, half of relevant amount, which is 2997. Okay, so in summary, okay, always give summary when 2-3 things are there that you need to do. It's good to give summary. Balancing payment, I will give you the tax year. Always give the tax year next to it so that you don't become confused. And first payment on account. 2144, this amount. Now you have to carry forward here. Then this amount, 2997. Together 5141. This is your total payable. By which date? 31st Jan 2024. So if you see this, basically practically every year this is what's happening. When you are paying the balancing payment, on the same date you are also paying the first payment on account from the current year. Balancing on payment comes from the previous year, payment on account, first payment on account in that year. So two things you are paying on that same date. That's why even though it looks so we cannot say balancing on payment separate date, first payment on payment on account separate date. No, everything falls on that date only. But the amount that you are taking based on which is different. For balancing payment comes from the previous year. First payment on account is in that current tax year, but the date is same. So you see sometimes it's very easy to get confused when the date is same, because it's coming from two separate things. Now we'll go to test your understanding too. Since you have understood this concept, this will be easier for you. Here you are given class 2, class 4 CGT also in order to confuse you. But for balancing payment, you need class 2 and CGT. Okay. Payment on account 8000 is given. Now, even though balancing payment for the tax year is this and first payment of the tax year is this, tax year is different, amount is different, but will be paid on the same date. Okay. So now, first we'll always work on the balancing payment. It's always good to work with the balancing payment first because it comes from the previous year. Finish off with the previous year. Then current year, current one is easier to work like that. Later one finish first, okay? It's like first in, first out basis. When you do stock valuation, first in, first out, no, whatever comes first, you value start based on that price, you start valuing. Same here also. And if you see the sequence of the requirement also, they will ask you also in that order. They will not confuse you. First they told identify the balancing payment. Then they told first payment on account. So start with the balancing payment. But if you start the other way around also, no issue. So what is the tax? Remember, total tax payable. It is this. This is for balancing payment, okay? Because it is balancing payment, you don't have to do any adjustments. You need class 2 NIC also there, you need class 4 NIC also there, you need CGD also there, okay? And income tax already done. PAYE already deducted. So total tax payable is 13,706. Deduct your payment on account is 8,000. Once it is deducted, balancing payment comes 5,706. By looking at the question, tell me the payment date. Tell me the payment date. Both will be paid on the same date. It will be paid 31st Jan 2024. This is the date. Okay, one answer I've finished. Now, so balancing payment is done. Okay, now first payment on account is 2, no? First and 2, but we are working on first because the second one will be on 31st July. Different dates. We are worried on when you are paying the balance payment and first. They asked you first. If they would have asked you the second payment on account, dates would be different. It would be 31st July 2023. So because of the date, okay, that is a different. Now, I'm sorry, first second payment on account for the different tax year. Okay, I have taken the previous year, 31st July 2024. Dates are different as well. Just give me a minute. Now, so we are taking, you need to do a working here. Your income tax payable. So your income tax payable is this 8,300. After you deduct pay from income tax, 8,300. So 8,300. And what are you taking? Remember, this is payment on account. So you're not taking CG2, CGD and class 2 NIC. Class 4 NIC you have to take, which is 800. Go up and check. Check once. It's 400. I'm sorry, it's 800. Okay, 800. Yeah, 800. I've recorded correctly. So the relevant amount is 9,100. Take half of it, which is 4550. So this is your payment on account. First payment on account. If you take the summary, just add this and this and pay by 31st Jan 2024. So now we are moving on to the interest and penalties. We are over with balancing payment and payment on account, the way we pay. So there are two types of interest. Interest on late payment, which is 3.25% per annum, and repayment interest. When the HMRC pays to you, on that also you are going to have an interest. With interest they will pay you, but it's a small portion, 0.5%. Okay, and in your exam calculations, always perform your answer to the nearest month and nearest pound, unless the question says you to nearest decimal, two decimal places, or exact month. Most of the time I've not seen a question where they say exact month or in exact terms, but nearest month in pounds only. It's advisable. Now, late payment interest, okay? From which date the interest starts calculating? automatically interest will be charged the moment you start paying the tax late, even if it's 1 day. Okay, so here interest can arise in respect of your payment on account. Just we have covered payment on account. On that also, if you pay late, interest will arise. Second, balancing payment. Third, any tax payable following an amendment to self-assessment. Let's say your self-assessment you have amended, and now you have to pay extra tax. Okay, so if that also you're not paying on time, that extra tax, interest will be there. Any tax payable following a discovery assessment. We have not gone through discovery assessment yet. We'll be going it a little bit later in this lecture itself. So discovery assessment, any tax you have to pay because of that process, interest will be there if you're paying late on it. For that also we have time and date. All interest is charged on a daily basis. The more late you are, the more interest you're accumulating. So this interest starts from the date when tax was due to be paid to the date of payment. Okay, now we'll be doing questions to understand this interest better. So illustration 3 and test your understanding 3. Questions are similar. So we are going to do the similar nature of questions together itself. Taxpayer pays payment on account for the tax year on 31st March 2023. They have paid late, and 31st August 2023. That means the first and the second, and the balancing payment on 30th April 2024. All they have paid late. First payment on account, second payment on account, balancing payment. But how many days and what is the interest? That is what you have to calculate. And state the period for which interest will be charged. Okay. Date, very important. Round it up to the nearest number of months. Okay. Three things: first payment on account, second payment account, balancing payment. So let's do that. And test your understanding 3 is of a similar nature. Okay. So we'll finish first with illustration 3. Okay. First payment on account, second payment on account, balancing payment. Calculate the date. You have to pay first payment by 31st Jan 2000. 31st Jan 2023. Correct date. Second one you have to pay 31st July 2023. Balancing payment 31st Jan 2024. These are the correct dates. Okay. So first payment, it will run from which date? From the date you have started paying late. 31st Jan means the next day. From next day onwards, interest will started being calculated. So from 1st of Feb 2023 up to which date? You have paid 31st March to 31st March 2023. How many months? Whole of February and March, 2 months. Okay, you might say it will be less than 2 months because February has 28 days and March has 31 days. If you add, might be more than that, but it's fine. Answer is nearest to month. Next, from 1st August 2023 to 31st August. Sorry, the 1st August because end is 31st July. One month. And balancing payment 31st July 2023, sorry, 24. So 1st Feb 2004 and up to 30th April 2024. February, March, April, 3 months. Okay. In this question, it's easy because it is not in the mid of the year. It is in the start or the end of the month. So it's easy to take the actual number of month, the total month. But in your exam, you might be given, let's say, 1st of April to 12th of April. Like in days, they might give you, right? You might have to calculate some days also. Now, so question asked you, identify the payments on which interest will be charged and state the period for which interest will be charged. They didn't tell you to calculate interest. You cannot calculate it, okay? Because they have not given you the amount. They only wanted the dates. But test understanding 3 has the date. So we'll do that. You see, due date has been given, actual date has been given. So we'll calculate that. So if you check from 31st Jan to 20th, it starts from 1st of Feb. So the whole month of Feb, 1 month delay. Next, from 1st of August, 31st August, again 1 month delay. From 1st of Feb to 31st March, 2 months delay. So now when you are calculating, okay, just I will show you for the first one, second and third, you should be able to do it. Just take the number of months, 2100 into 1 month, 1 divided by 12 into the percentage, 3.25 percentage. This 3.25% remains fixed for the others also. The only difference is number of months and the amount. This will be 1 month, this will be 2 months. That's it. The calculation, the way you do is same for the other two also. So make sure that you should be able to do it and get the answer. Okay. Multiply by 3.25%. Why? Because for late payment interest is 3.25% fixed. And in your exam, they will give you that rate, 3.25%. Okay. So the answer of the 3 is 6 pounds, 6 pounds, 8 pounds. Make sure that you are able to get it. Okay. Now we have interest on incorrect claims to reduce payment on account. We have covered incorrect claims to reduce payment on account. On that also we have interest. Okay. So if excessive claim is made to reduce payment on account, interest is charged. And the difference between actually that you have to pay and amount that you have paid, the difference between that is the charge. That charge is based on that difference. Amount actually paid versus amount that should have been paid. Amount that should have been paid is the lower of the two. The original payment on account based on the relevant amount for the previous tax year, this we all know, 50% of the final tax liability. But you are excluding CGT and class 2 NIC, net of pay, for the current tax year. Okay, when you're taking that 50% of the final tax liability on that current tax year, it is based on this only, excluding CGT and class 2 NIC. That means you are only taking income tax and class 4 NIC. Based on that, whichever of these two is lower, that should be the amount that should have been paid. Amount actually paid, you know it, but amount that should have been paid, they are giving you. Now we'll do 2 questions on this to understand how do we calculate interest on the incorrect claims to reduce payment on account. Illustration 4 and illustration 5. Similar nature, but illustration 5 will have more than illustration 4. So here you have to identify the amount of interest and also state the period for which interest will be charged. Okay. So here for the tax year 2021-22, this one is the relevant amount. And therefore payment on account is 2,500 for the tax year. But a claim is made to reduce this 2,000 each. These payments are made on time. Later, the actual tax liability was 4,500. The correct balancing payment is you deduct from 4,500 2,000, and this one is paid on 31st Jan 2024. You need to calculate the interest that will be charged. Okay, what's happening here? Can you see? They are making a claim to reduce the POA to 1,000, right? But actually, payment on account should have been reduced to half of this 4,500. Why? Check the actual tax liability. It turned out to be more. Okay. So if you take this tax and take half of it, that should be your actual this thing. So if you take half of 4,500, it is 2,250. So your payment on account should have been reduced to this amount rather than up to 1,000. So because you are claiming more, what is the difference? You have to take the difference between the amount that should have been paid, amount you have actually paid. Amount that should have been paid is 2,250. How do you get the amount that should have been calculated on the current tax year? Take half of it. That is your payment on account, which is 2,250. Payment that you actually paid is 1,000. So minus 1,000, which is 1,250. On this, interest will be charged. From which date? When should you make the payment on account? First payment on account is 31st Jan 2023. Isn't it or not? So it runs from 1st of Feb 2023 up to, if you see the date, 31st Jan 2024. That is for the first payment. Second payment is on 31st July. Second payment on account is 31st July 2023, right? So it runs from 1st August 2023 up to 31st Jan 2024. Interest will be from this date. See, the question did not ask you to calculate interest. They only told you identify the amount on which interest will be charged. So amount you have identified 1,250, and you have stated the period also. Read the question carefully. Are they actually asking you to calculate interest or amount on which interest will be charged? There are two different things. Coming to illustration 5. Now you know the nature. Looking at it, illustration 5 will be a little easier. Okay. So they have given you. Here also they are claiming. And it is 4,500 payment on account. They claim to reduce it to 3,500. Okay. So this is 3,300. But actual tax liability is this. And they have given you CGT also. And Hannah paid the balance of the tax due. Balance of the tax due means it is balancing payment. BP. This is what they are talking. Identify the amount on which interest will be charged and say the period for which interest will be charged. Please understand the nature of the question. Here also they are not saying you to calculate interest. They are only telling you the amount on which interest will be charged and the period. Okay, so let's do that. Okay, so now can you reduce the payment on account to 3,500? you can only make that claim to reduce the, go back to what you have studied. Claim to reduce payment on account can only be done when actual tax year is less than the previous year. But if you see in the previous year, okay, tax liability was more. And this year, if you see, it's 10,000. It's way more than the previous year, more than 1,000 also. So you cannot have that claim to reduce your payment on account. Okay. So now we'll calculate the relevant amount for the tax year. You have to calculate the relevant amount. See, if you see Hannah's payment on account for the tax year based on her income tax liability for the tax year. Previous tax year is 4,500. Payment on account is always half of your tax liability, so double it. So if you take 4,500 into 2, it's 9,000. That means the relevant amount is 9,000. Understand? Sometimes you have to be very witty and sharp, and you should have a very good presence of mind in this. This is a little tricky. Many of you might not be able to identify. Okay, to compare your income tax liability, the current with the previous, you need the previous income tax liability, but they've not given you. They've already given you the payment on account as 4,500. Right? But even with then you can do, because payment on account is half of your income tax. So double your payment on account to get your income tax liability. Okay? Which is 9,000. So if you compare this 9,000 with 10,000, 10,000 is more. This year is more than the previous year. Can't reduce. Okay? So amount that should have been paid on each of the due date has to be 4,500 only. It cannot be reduced to 3,500. Understood? And if you see first payment, so we'll talk about first payment on account now. Should, okay, so they should have paid. Always understand. Should have paid 4,500. Actually paid 3,500. Difference is 1,000. On that 1,000 interest will be taken. Okay. But this was paid on time if you see. 29 Jan 2023. Because date was 31st Jan 2023. They paid 2 days before. So because they have paid on time, okay, interest will only be charged on that extra 1,000. And it is from 1st of Feb to 28 Feb. Because this is the date when you have paid everything. So 1st of, okay, I'll write here. Interest will be charged from 1st of Feb to 28th Feb 2024. 28 days. But you'll be taking it as 1 month. Okay. Interest on 1,000. If you see the next second payo, what about it? 3,500. Tell me. This is a little tricky. This is not the same as what you're thinking, like first payment on account. Think. I'm giving you a few minutes to think. There is something else wrong in the second payment on account. What is it? Here, with the amount itself is wrong. You're paying late. That is fine. Amount itself is wrong. Two things are there. Two mistakes. See, amount is also wrong. That's why I'm putting a cross sign to show that is amount is wrong. Okay, so when amount is wrong, on that amount itself, whole amount you have to pay interest. Okay, so your interest runs from now here on the 3,500 interest will be charged from this date to this date. You have paid here 1st of August because date for second payment on payment on account date is 31st July 2023. So next day 1st August to 31st August 2023. 3,500. On this 3,500 you have to pay interest. Okay. Then on the additional 1,000 not paid, remember 1,000 you have not paid. On that 1,000 also you have to pay additional interest. That runs from 1st August to this date for late payment 28 Feb 2024. Okay, because second payment on account you made at this date. Okay, first interest was on that 3,500, so from 1st August to 31st August. The other 1,000 which runs from the 1,000 additional that you have not paid runs from 1st of August 2023 because it ends on 31st July, right? So the next date 1st August, but until this date 28th, the dates are different, ending dates are different. 28th February 2024 interest will be charged until this date, but for incorrect amount only till 31st August. That means interest on 3,000 first 3,500 will be only till this date, but interest on that additional 1,000 that you have to pay will be till 28th February 2024. Okay, and remember when you're solving payment on account, I mean amount that should have been reduced but have not reduced, it should have been 4,500 but it was 3,500. We only change it in first payment on account. That's why in first payment on account we have not said that 3,500 is an incorrect amount. We told okay 1,000 additional we have to pay. On the 1,000 additional we paid interest. So that is solved. In the second payment on account, then this has to be 4,500. Then we cannot take 3,500 and then only work on the additional 1,000. No. Okay. So in the first payment on account only we are adjusting with that additional. Then onwards the full amount 4,500 has to be paid. If it's 3,500 less than that, that amount whole amount is incorrect. Okay. Then on balancing payment, I know it's a little bit tricky, but with the practice it will come. Even for balancing payment you need to work a bit. What is it? If you see here 10,000, but this is for the current year. Okay, if you see income tax in the previous year, we have got 4,500 into 2 as 9,000, right? So it is only the remaining 1,000 that will attract an interest charge from 1st of Feb 2024 to 28th Feb 2024, because balancing payment you make it on 31st Jan 2024, right? So interest will start one day later, 1st Feb 2024 to 28th Feb 2024. Okay. So now what about capital gain tax? How do you take balancing payment, by the way? The income tax, net of any pay and everything from the last year, right? So last year's relevant amount is 9,000. Okay. So from this 9,000, 4,500, 4,500. But they have taken 3,500 and 3,500. The difference 1,000 on that only interest. That's why even in balancing payment, only on that additional 1,000 interest will be charged. Capital gain of 2,500. What about this? It also incurs interest from 1st of Feb 2024 to 28th Feb 2024. Because for balancing payment, capital gain tax comes. So that will charge interest. Okay. From which date? 1st Feb. Because 31st Jan 2024 is the closing date. So 1st Feb 2024 to 28th Feb 2024. Okay. Now we'll be discussing repayment interest. Repayment interest. Now, where HMRC is going to pay interest for overpayment of tax. Here, it runs from the later of the date tax was due or date HMRC actually received the tax. You see, when it comes to repayment, HMRC is unfair on you, you can say. Why? Because when they have to pay you the amount with the interest, the amount of the tax with the interest, they want to pay you the later. They are taking the later date. But when they have to take interest from you, they are taking the earlier of. Okay, so that they receive more and they pay you less to the date of repayment. Where interest is paid, it is only paid on the amount of tax that should have been paid. So if you're deliberately overpaying, you are not going to attract additional interest on that. Remember that. So there's no benefit of you on paying overpayment of tax. Penalties for late payment. Late payment interest is not a penalty. Understand that first. It is just to compensate HMRC from for the advantage of the taxpayer paying late. Okay, if taxpayers are paying late, it is only to compensate for that to HMRC. That's why they are paying interest on that. It's not a penalty. To further encourage payment of tax by due date, penalties can also be imposed by HMRC on other taxes like class 4 NIC, CGD, class 2 NIC, income tax. If they are paid late, penalties will be imposed. Now, penalties, understand, do not apply to payment on account. Okay. Penalties are calculated as follows. Remember this. If you are paying tax more than 1 month late, 5% penalty. More than 6 months, additional 5%. Additional 5% means it's not 5%. First 5%, again another 5% on that amount. More than 12 months, additional 5%. 5%, then 5%, then 5%. Okay. Penalties for late payment. Technically, in real, if you see, penalties apply if tax is paid more than 30 days late. That's why first is taken as 1 month. For second period, 5 months and 30 days late. But we round it up to 6 months. The next one is 11 months, 30 days late. But for your taxation exam, they are rounding it to the nearest month. That's why 1 month, 6 months and 12 months. And under certain special circumstances, HMRC have the power to reduce that penalty. If HMRC feels that penalty is inappropriate or disproportionate, that means they are charging too much as a penalty, which you will not be able to pay, looking at the size of your firm and things like that, or your income level. Remember, taxpayers' inability to pay the tax is not classified as a special circumstances. Okay. So now we have moved to claims. But before we start with claims, let us do questions on the repayment of tax, interest on the repayment. Illustration 6 and test understanding 4. So here, question is asking you interest and penalty. Two things. So interest, whenever you have to calculate interest, remember the percentage is important, the date is important, and the correct amount on which you are charging interest are important. First get this three right, and then comes the penalty. First finish the interest part always, then comes the penalties. Okay. So the amount is 5,000. This is a balancing payment due for the tax year 22-23. Paid on this date. Only 1,200 of this was paid. So the balance. Okay. Remember, you have paid it on time. Okay. But you have paid less amount. So for that extra amount, interest will be charged. The balance between 5,000 and 1,200. 3,800. On this interest will be charged. From which date? From 1st of Feb 2024 until you don't pay that amount. They have not given you, so we don't know the end date. Coming to penalties. Remember that table? Percentages. Understand how long they have not paid. They should pay 1 month within the due date. So, if they don't pay by 29th February 2024, why 29th? Because it's a leap year. 2024 was a leap year. That's why 29th. You have to consider these leap years also, by the way. Okay? Very important. So, within 1 month means if you take from 31st Jan, 1 month will be 29 Feb. Okay? I mean, you will not sit and exactly count 30 days. I know it's less than 30 days, 29 days, but yes. 29 Feb. So 1 month after the due date. Due date was 31st Jan, but within 1 month, if you don't pay, you are going to charge an interest of 5%. This is a penalty, not an interest, I'm sorry. 5% on this 3,800. Because that is the amount you didn't pay. And if you don't pay by 31st July, that is from 31st Jan, you have to calculate 6 months. 6 months will fall on 31st July. If you don't pay by this, another 5%. So if you take 5% of 3,800, it is 190. Another 5% means another 190 you have to pay. And if you don't pay by 12 months, that is 31st Jan 2025, another 5%, that means another 190 you have to pay as a penalty. So 190, 190, 190. Now we'll go to test your understanding 4. Calculate interest. calculate penalty. Whenever they say calculate, you have to know the rates. Okay. Their tax liability after payee but before payment on account, income tax CGT. Okay, payment on account of 4,000 were made on relevant date. Balance of the tax due was income tax and CGT. Now calculate interest. So here, remember for CGT there is no payment on account. Okay. So we are only income tax is paid on payment on account. And what is the relevant date for balancing payment? Dates are very important when you're calculating penalty and interest. Balancing payment, okay, what is the date? Relevant date. Check the year. 31st Jan 2024. Okay. So they have given you the income tax and CGT. Okay. Of 6,000. And they also told that payment on account in total were made on the relevant dates. That means you don't have to worry about payment on account. Already on the relevant date, it has been made. That means 31st Jan 2023 and 31st July 2023, it has been made. Now we only want the balancing payment to be made correctly. Okay, that is 4,000. So from your income tax 6,000, deduct payment on account 4,000, you will be left with what? 2,000. Okay. But since we are working on interest and penalty, CGT will be there. Because balancing payment requires CGT. Only payment on account does not require CGT, which is 3,000. So interest, okay, will run for income tax separately, CGT separately. Okay. How much? It is 2,000 for income tax. From which date? Date starts from 31st Jan 2024. So interest means when you are paying late. So 1st of Feb 2024 to you are paying 29 Feb 2024. 1 month. So it is 1 month. So you are going to take 1 month into what is the percentage? Late payment 3.25% into income tax 2,000. It is 5. This is the interest. For CGT, it is 3,000 and you are paying 31st March 2024. So it will run from 1st of Feb 2024 to 31st March 2024. 2 months. 3.25% into 3,000. 16 pounds. Interest part is over. Coming to penalties. Remember, this was 1 month. So 5% penalty. This was more than 1 month. So 5% and another 5%. So 5% if you take on the amount. Okay. Sorry, I'm sorry. Here no penalty because it is not 1 month. It is not 30 days, less than 30 days. No penalty here. Okay. For income tax, no penalty. CGT has to have penalty. 5% of 3,000 if you take, it is 150. It has been late for 2 months. Wait. I'm sorry, it is only 5 months because more than 1 month. It's not within 1 month. I'm sorry, I got confused. It's more than 1 month, but it was less than 6 months. Within that period, then only 5% on 3,000. So 150 is the penalty for CGD only. Okay, it's more than 1 month late. So 5% of 3,000. Now, total interest and penalty, if you add, it will be 5 plus 16 plus 150. Total will be 171. Okay. So now, a claim for a relief, allowance, or repayment can be made by HMRC. There are three situations: relief, allowance, repayment. There are three separate things, and you can make a claim for each of them, usually via tax return. Amount of the claim, when you are making a claim, just don't say I claim that I want to reduce. You have to quantify the amount. Okay, whatever time you are making that claim, within that relevant time period where you have to make the claim, you have to quantify the amount. For example, let's say you are claiming a loss relief. Sometimes when you're making a loss, you might say because you are making a loss, you have paid more tax, right? So you can make a claim to refund you back because of a loss you have made. If you have made a loss, they are going to give you a loss relief. Okay, so when you are claiming a loss relief, you have to state the amount of the loss. Then claims for earlier years. Let's say in the early years you have made a loss and you want to claim it now. Okay, so the most obvious example is claiming of loss relief for earlier years. There are certain claims that is for earlier years. One is loss relief. One example. Basic rule is this claim is established in the later year, calculated based on the tax liability of the earlier year. Claim for earlier years, how it works. This is how it works. Tax liability for the earlier year is not going to change, but you can reduce your tax because of that claim this year. You understanding? So the tax reduction, that means that claim is set off against the tax liability for the later year. Previous year tax liability will remain as it is. You're not going to touch it also. But this year you can reduce your tax because of the claim you have made. The logic behind this is it becomes very confusing if you have to go back and keep on changing the figure, tax liability. So in order to avoid that, reopening the assessment of earlier year, they are saying don't touch the earlier year figure, adjust the future year by setting up the claim with your tax liability. So separate claim can be made to HMRC, who will be refunding the tax due. You can make. If you have made it, HMRC will refund the tax due. As the claim is only quantified by reference to the earlier year, when you are quantifying it, when you're making a claim, you have to make a reference to the earlier year. So payment on account that are based on the relevant amount for the earlier year do not change. Okay, this will not change when you're making the claim. That's why often you cannot make a claim for it. So payment on account that are based on the relevant do not change. Okay, don't touch that. But if it's for loss relief and all, last year you cannot change tax liability, but this year you can reduce that loss relief by this year's tax liability. That's how it works. Now we are going to do a question on this when you're claiming for earlier years, how it works actually. Illustration 7, claiming for earlier years. So explain how the taxpayer will receive the tax refund as a result of the relief for the loss. Okay, relevant amount is 4,400 for tax year 2021-22, and trading loss that they make this year is 1,000. They make a claim to offset this against total income for the tax year of the previous year. So now first we'll start with, because they talked about relevant amount. Okay, whenever they're mentioning you the relevant amount means they are indirectly hinting you to payment on account. Understand this. I'm sorry, it's payment on account. Okay, POA. So you have to work out on this. What would be their payment on account? Half of a relevant amount. Relevant amount is 4,400. So half of it will be 2,200. Which will be paying. What are the dates? '22, 31st Jan 2022. Taxpayers relevant amount for the tax year. This is previous year. So this year it will be 22, 23 and Jan, July, Jan. Okay. So it will be this. This will not change as a result of the loss relief claim. This will remain as 2,200 only. So the tax refund due will be calculated at the taxpayer's marginal income tax rate. Okay. So when the tax refund is made, it will be set off against the tax liability for the tax year 2022-23. Okay. See, the question didn't say you calculate. They told you explain how the taxpayer will receive the tax refund. So once they receive the tax refund, it will be set off against the tax liability for the current year. So because of this, it will affect the balancing payment. Okay, I will write it for you. Refund set off against tax liability for the tax year 2022-23. Okay, so affecting balancing payment. It affects balancing payment on which date? 31st Jan 2024. Or if there is an insufficient tax left owing, HMRC will make a refund. If there is an insufficient tax owing, HMRC will make their refund. Okay. Because you are having a loss, right, in the tax year. So if you are not able to pay back, HMRC will make that refund. Claims for overpayment relief. Let's say in an assessment you have made an error or a mistake. Taxpayer can claim that relief. Okay. But the claim must be made within 4 years of the end of the tax year concerned. So for 2022-23, claim must be made by 5th April 2027. Add 4 more years to 2024. I'm sorry, 2023, because they didn't say following the end of the tax year. They said at the end of the tax year. Claim can be made in respect of errors made. Okay. And mistakes arising from not understanding the law. Let's say someone made a mistake, some taxpayer, while they were calculating because they didn't understand the rules, or they have made an error. For that also, claim can be made for the relief, refund. Now we are moving on to compliance check. Okay, I've mentioned you earlier that sometimes HMRC uh, checks whether you are complying or not, but under some situations. Let's see what are those situations and what is the time period for compliance checks. Okay, HMRC have this right to make sure that self-assessment tax return are complete and accurate. HMRC can anytime have a check. Okay, next, before they do this, they have to give a notice that they are going to start a compliance check, also known as inquiry. It should be written. The written notice must be issued within 12 months of the date of the return is filed with HMRC. If the return is filed on time. Okay, we know the correct time, right? So 12 months from that, you add compliance check has to be, the written notice has to be issued by that date. If the return is filed late, notice must be issued within 12 months, till 12 months, but of the 31st Jan, 30th April, 31st July, or 31st October next, following the actual date of delivery of the tax return to HMRC. That means whichever falls next, whichever is nearer to it. For example, if you are paying on, let's say, 5th of April, so the next date is 31st July. You cannot go to 31st Jan, you know. So that's why they said 31st Jan, 31st Jan, 30th April, 31st July, or 31st October. Next, following the actual date, whenever is the actual date of the delivery of the tax return to HMRC. Okay, should be issued within 12 months of this dates. That means notice has to be issued. But this is only when the return is filed late. If it is on time, then 12 months from that date. Okay, you have to remember both. If it's filed late, what is the date of issuing this written notice? If it's filed on time, what is the date of issuing the written notice? Both you have to know. We'll do questions on it, don't worry. Once the above deadline has passed, taxpayer can normally consider self-assessment for that year as final. That means you can conclude that compliance check is over. I mean, whatever self-assessment is done, it's final. No compliance check. Compliance check cannot be done after the deadline is passed. So whatever self-assessment taxpayer has done, that is considered as final only. Okay, HMRC have to accept that figure. Now, information requested by HMRC should be limited to that connected with the return. Okay, when compliance checks are done, these are the things you have to think about. Whatever information HMRC is requesting from you, you have to give it, but those information should be only connected with the return, not any additional information or confidential information. Next, an appeal can be made against the request. Yes, let's say HMRC have requested to do a compliance check. You can make an appeal against it. Compliance check inquiry ends when the HMRC gives a written notice that it has been completed. HMRC, until HMRC does not give you in writing that they have completed the compliance check, it's not done. Okay, also the notice will state the outcome of the inquiry, also what they have discovered through that compliance check. Taxpayer has 30 days to appeal against any amendments by HMRC. The appeal must be in writing. Remember this dates, very important date. Who can appeal against whom, from whom, who has the power over you. Have to understand all this hierarchy of powers. Okay, next, further details. So compliance check may be made as a result of any of this following. Okay, first reason, they are suspicious that income is undeclared. You have not declared all the income. Second reason could be deductions incorrectly claimed. Third reason could be HMRC's, like some other information might have come to HMRC's position that you are hiding. Fourth, just a random review process. Fifth, some additional points. HMRC do not have to state a reason for the compliance check. Okay. If they want to have a check, they can check. They have that authority, they have that power. They don't have to give you reason why they have to do the compliance check. Because if they keep giving reasons to everyone, everyone will become aware, and it's obvious that any fraud or anything has taken place easily. They can hide it from the HMRC check. That's why they don't make anyone aware of it. I mean, they write it in notice that they are going to do compliance check, but they don't say why are they doubting you, or why they're suspicious, or why they're suddenly doing this random review. They will not give you the reason, and they should not do it also. A compliance check can be made even if HMRC calculated the taxpayer stated tax liability. You see the power of HMRC now, so don't underestimate them and don't try to play with them. Okay, they're smarter than you think. HMRC can demand that the taxpayer produces any or all of the following. First one, documents. Second, accounts. Third, written particulars. Fourth, full answers to some specific questions that is asked by HMRC. A closure notice must include this. Okay, confirmation that no amendments are required. HMRC's amendments to the self-assessment. Now we are coming to discovery assessment. Even this word we have covered before. I told you, wait, we are going to cover it. This is the right moment to know what is discovery assessment. Okay. So HMRC must normally begin compliance checks into a self-assessment return within 12 months of the date the return is filed. We know this. However, a discovery assessment can be raised at a later date to prevent the loss of tax. Sometimes they can do that. At a later date, they might say that they want to do a discovery assessment. Remember, the use of a discovery assessment is restricted where a self-assessment has already been made. If a self-assessment has been made, discovery assessment is restricted. Unless, okay, even though sometimes self-assessment is done, discovery assessment can be done unless the loss of tax was brought about carelessly or deliberately by the taxpayer. A discovery assessment cannot be raised where full disclosure was made in the return, even if this was found to be incorrect. If you have disclosed entirely everything, discovery assessment cannot be done, even if that amount is incorrect. Then, HMRC will only accept that full disclosure has been made if any item have been brought to their attention. Maybe in a covering letter or in a white space on the tax return. Okay. For all who don't know what is this white space, you Google it and check how a tax return on UK looks like. There will be some white space left. So there, if you disclose any information, HMRC will look into that. Okay. That means that is taken as a full disclosure only. It's counted as full disclosure is made. Then discovery assessment will not be done. Then information contained in the attached documents will not constitute full disclosure if significance is not emphasized. If you attach something and you don't explain the significance of it, it is not taken as a full disclosure. Only a taxpayer who makes full disclosure in the tax return has absolute finality 12 months after the date the return is filed. That means his amount, whatever is there, whatever tax he has calculated, will be taken as final 12 months after the date the return is filed. If you have disclosed it, that was a full disclosure. That means his amount will be taken as final without any discovery assessment or anything. That will be accepted. Now, even a discovery assessment can be appealed. Okay, this may be appealed against. And The time limit for issuing a discovery assessment is this. You need to know this table. If it's for a basic time limit, time from end of the tax year. Okay. That means for basic time limit by 5th April 2027. Because end of tax year is 5th April 2023. If you add 4 more years to it, 2027. If it's a careless error and then that's why they want to make a discovery assessment, 6 years. That means by 5th of April 2029. And if it's a deliberate error, 20 years. So by 5th April 2043. Okay. Now we'll be going through appeals. Taxpayers can appeal against a decision made by HMRC. Okay, but this must be done within 30 days of the disputed decision. Most appeals are then settled by discussion between taxpayer and HMRC. But if you are not satisfied with the outcome of the decision, you still can proceed in two ways. First one, either you can request that the case will be reviewed by another HM officer, or you take the case to independent tax tribunal. Okay, what is this tax tribunal? Tax tribunal is an independent body, okay, where your cases will be heard by independent appointed tax judges. Okay, they are specialized for this field, that is on tax. They are judges same like court, but it is only on tax. Now here they have two layers. First one is known as the first tier tribunal and the next one is upper tribunal. Okay, so under the first tier tribunal, most cases in fact are heard here only. So it deals with default paper cases. Like these are some simple appeals. Okay, like if you have any issue against a fixed penalty, okay, then it will be dealt with through first tier tribunal. And usually you don't have to hear both the sides for this you can decide. Next is like basic cases like straightforward appeals. Okay, so also the exchange of paperwork is very minimal here. Then we have standard cases where you might need a little detailed consideration of issues and maybe a formal hearing, like hearing both the parties, HMRC and the taxpayer. And complex cases. Mostly complex cases will be transferred to the upper tribunal. So in short, first tier tribunal, they deal with simple cases, easy ones, the everyday issues. But the more complex the issue, upper tribunal will handle it. Now, upper tribunal mainly, okay, so they review and they decide appeal from the first tier tribunal. Next, if it involves complex cases, specialized knowledge is required, okay, and also formal hearing. And often it could be long or complicated issues, points of principle or large financial amounts. For this issues, it is dealt through upper tribunal. Hearings are held in public and decisions are published. And later, the decision of upper tribunal may be appealed further to the Court of Appeal. But remember, when you are appealing, it should relate to a point of law. Your ground of appeal should be always relating to the point of law, not your personal opinion. Then now we are moving on to penalties. Standard penalties. Penalties differ. Sometimes penalties are fixed, sometimes it varies. So we have standard penalties and this applies in two key areas. First one, where you are submitting incorrect returns and it's for all the taxes. CGT tax, VAT, inheritance, income tax, capital gain tax, corporation tax, any type of tax, incorrect returns penalty. Next one is only for this particular type of taxes, that is for failure to notify liability to tax, that is income tax, CGD, corporation, VAT and NIC. For this type of taxes, if you fail to notify that you are liable to tax, penalties will be there. Now, penalties are calculated as a percentage of a lost revenue. Lost revenue means whatever tax they have lost, they were not able to collect from you. It's a loss for them, it's a revenue for them. That's why we say it's a potential lost revenue. So percentage is calculated on that lost revenue, lost tax you can say. That's how penalty is calculated. Because of that error or failure to notify, tax was unpaid. So that is known as lost revenue. Now, you need to remember this. And you need to remember the percentages. The taxpayer's behavior as well as the percentages. Because based on the taxpayer's behavior, only percentages will change. So if it's a genuine mistake, and remember, genuine mistake only for incorrect returns. If you are failing to notify about your liability tax, penalties will be there. Okay, but if it's for incorrect returns only, no penalty. Then if you have made a careless mistake, okay, 30% penalty. And you have made it deliberately you have done it, incorrect returns, but you have not concealed it, you have disclosed it, 70%. You have done it deliberately and you have concealed it also. Concealed means you have hide it, you didn't disclose it also. Then 100% penalty. Coming to all incorrect return, okay. What happens when you submit an incorrect return? You are paying less tax under statement of taxpayer's liability, and no reasonable steps have been taken to notify HMRC of the error also. Includes, so under incorrect return, this all comes, okay. If you are giving them false information, if you are withholding information, if you are inflating your loss or claiming more allowance and relief, if you are inflating a tax repayment claim, okay, that means you want more, and you are submitting incorrect accounts in relation to a liability. So all this comes under incorrect return, for which penalties will be there. Now, sometimes you might have more than one error in a return. If it's more than one error, separate penalties will be charged on each error. Okay. And failure to notify liability. So we are finished with incorrect return. Now, what if you fail to notify HMRC about your tax? Then it applies here. These are the situations where failure applies. Taxpayer has a liability. Okay. They have a liability to tax and a notification is required, but they didn't do it. Then it's a failure to notify HMRC. Next, notification of chargeability is not made to HMRC. Failure. So in this case, 30% standard penalty applies. Okay, where the failure to notify is not deliberate. Okay, it does not matter whether you have made a genuine mistake or not. In the previous table you have seen, for incorrect returns, it started with 0%. But here is not like that. Whether you make a mistake or not, okay, but you have not deliberately done it, 30% standard penalty applies. Okay, next all you have to follow from that previous table. That means higher penalties apply for deliberate failures as set out above. That table you have to follow. Now, maximum penalties can be reduced. Okay, can be reduced where certain conditions are there. Number one, taxpayer informs HMRC of the error. If you inform HMRC of the error that you have made, HMRC will reduce your maximum penalty. Okay, for example, you have made the disclosure. So if you are going to cooperate with the HMRC, HMRC is also going to cooperate with you by reducing your penalties. If you have disclosed, why would they want to charge penalty? Next, you are working with HMRC to get the amount of tax unpaid, right amount of tax unpaid. Third, with larger reductions given for unprompted disclosure. If before HMRC have identified your error, you have disclosed it, it is known as unprompted disclosure. There is two types of disclosure, prompted, unprompted. Prompted after HMRC identifies some error has been made, then you disclose. Maybe HMRC is requesting you. Unprompted means you are willingly doing it. I mean, HMRC did not know about the error, they did not identify, nor they told you. You have disclosed it from yourself. So unprompted disclosure. If it's there, larger reductions they are going to give you for your honesty. Okay, maximum larger reductions in your maximum penalty. So it's always encouraged to disclose before HMRC discovers the error. Now, minimum penalties varies based on the behavior, deliberate, not deliberate, whether you have concealed or not concealed, genuine error. Next, whether disclosure was prompted or unprompted. I told you it's very important. You know the difference between these two. So an unprompted disclosure is made where a taxpayer makes a disclosure and has no reason to believe HMRC have about to discover. That means HMRC have not discovered the error, or they believe they are not able to discover the error, but you have disclosed it. Okay. So unprompted disclosure. Now, unprompted disclosure of a careless error can reduce your penalty up to 0%. Wow. Isn't it great? So always disclose. A taxpayer can appeal to the first tier tribunal against penalty being charged, amount of the penalty. You can charge against both. Penalties for late filings of return. Okay. So standard penalties are also being introduced for the late filing of tax returns. Whatever standard penalties we went through, 0%, 30%, 70%, 100%, they were also introduced for the late filing of tax returns also in phases. However, for your taxation exam from June to March 2024, these rules apply for individuals only. I mean, before it was very complex. For company has to pay something else and all. Now it is only for individuals. The standard penalties will be charged on the late filing of return also. So whatever those standard penalties we went through that table, same applies here. They made it easier for you. You don't have to know that phases. Now, date return is filed and penalty. You have to remember this for your exam. After due date. Okay. After due date, any date, 100 fixed penalty. Okay. If it's 3 months late, in addition to that 100 fixed penalty, you have to pay 10 per day. That means daily penalty. This is daily. Pounds 10 per day. Maximum 90 days because 3 months. Then 6 months late, plus the above penalty. That means plus that 100, you have to add either 300 or either 5% of the tax due, whichever is minimum. Okay. That means it cannot go below that amount. 300 has to be the minimum amount. It cannot go. That means 5% of whatever the tax due. Okay, they will give you the tax due, you have to calculate the tax. But 5% of that amount, if that amount is below 300, you have to take 300 because 300 is minimum. You cannot go below 300. That is the whole point. Okay, but if it's more than 300, you have to take that amount. 5% of tax due. Let's say it was 500, then it's 500 plus that 100 fixed penalty. So when you are adding plus above penalties, don't make a mistake here. When they say plus above penalties means you're not taking after due date and 3 months. No. Only the after due date. Only that 100 fixed penalty you are adding in the 6 months with either 300 or more than 300. Why more than 300? Because 5% of tax due could be more than 300. Okay. Now, more than 12 months after due date where withholding information was not deliberate, deliberate but no concealment, deliberate with concealment. So here above penalties plus. Above penalties means that 100 fixed penalty plus all this. If it's not deliberate, additional 5% of tax due, minimum 300. Same like the previous 6 months rule. 70% of tax due, minimum 300. So here also, lowest you can fall is 300. Below that you cannot fall. Okay. And 100% of tax due. So if it's not deliberate, percentages are always less. If it's deliberate, no concealment, it is more. And deliberate with concealment, highest, 100%. Okay. So the 70% and 100% remain same. The old thing is rather than 30% for not deliberate, it's 5%. But minimum remains 300 for all. So it's easy for you to memorize it because minimum is 300. Only the percentages of tax due changes. Now, later on in this lecture, we have questions also, which will help you understand better. Now, so the tax geared penalties for submitting a return more than 12 months late can be reduced by prompted or unprompted disclosure. Even if you are submitting a return more than 12 months late, still penalties could be reduced if you disclose, prompted or unprompted. Penalties for late payment of tax, this we have covered before. Tell me the percentages if I ask you. In the beginning itself, under interest and penalty, that was the third part in this lecture, which we went through. Okay. So in case you are not able to remember, don't worry, we have questions at the end. You will be able to solve it. Other penalties are there. So other than a late payment of tax and late file returns and failure to notify chargeability, these three, there are other two penalties. Okay. You have to know the offense as well as the penalty also for that offense. So for the particular offense, what type of penalty you have to pay, you have to know it. It's not that 30%, 70%, 100% is fixed for all the type of offense. No, differs according to offense. So the first offense, penalty for a fraud or negligence on claiming reduced payment on account. Payment on account we have covered before. Okay. So if there is a penalty, there's a fraud on claiming that reduced payment on account, then it's a penalty you have to pay. So penalty would be payment on account that should have paid less payment on account actually paid, the difference. That is the penalty. Next is failure to keep and retain the required record. And we have covered this before. For business owner, what is the time period? I suppose it was 5 years. Then for employees, how long they have to keep the records? We have covered records before. So you have to know the time period. If they failed, penalty is 3,000 per tax year. Now the PAYE system. Okay. PAYE system means PAYE stands for pay as you earn. PAYE. Okay. This system collects all income tax, not only income tax, also national insurance from employees. Okay. So employees will deduct this amount from employees. When giving the salary to employees at the end of the month, it is usually after deducting income tax and NIC, but employees also will know how much income tax was deducted in national insurance. Okay. Because it is deducted as soon as they get that earnings, that's why it is known as pay as you earn. Okay. The moment you earn it, you pay. So it does not come into your pocket, immediately it goes out. Now, under here, we have to know what type of payment. What type of earnings. So all payment of earnings that comes under employment income, later on we are going to go through employment income, okay, which comes under section B, income tax. Okay, on employment income we charge income tax, but yet now we have not covered. So for employment income, okay, they are deducted under PAYE system. So they are deducted as tax under PAYE system. There are so many ways of deducting tax, but for employees, mostly PAYE system. Next, all employers making payment of earnings are required to deduct the appropriate amount of tax from each payment by using payroll software. So it is employer's job. They have to do it by using some payroll software. They have to deduct or repay the over deductions. Now, so aim of the system is for the tax deducted from payment to date to correspond with the correct proportion to date of the total tax liability after allowance and reliefs of the employee for the tax year. Okay. That means whatever tax you have deducted from the payment, it have to match. It have to match to the total tax liability, because that is your total tax liability what you have deducted. That means after your allowance and reliefs, whatever is there, that is only your tax. That is only you have to pay. So it has to match with it. Correspond means match. To match that, pay system has been introduced. And it is only for the employee, not employer, not self-employed people. Okay. Now, so this system is used not only for income, even your national insurance gets deducted here. Okay. A non-cash taxable benefit. Sometimes employees get other than cash benefits from employer other than cash. They are non-cash. Okay. So for a non-cash, but they are taxable. If you are getting company car, if you are getting some medical insurance, free medical from an employer, on that also tax is there. Don't think they are free of cost. No. So non-cash tax, they are known as benefits, benefits in kind. We are going to cover that also under employment income later on. So a non-cash taxable benefit that is provided to employees by the employer, you have to report this to HMRC. Employer is the one who has to report this to HMRC at the end of the tax year. They have a form that is known as P11D form. For each relevant employee who has taken this benefit, there's a form known as P11D. Later on, after we finish pay system, we are going to go to the key forms of pay system, what each letter means. Okay, how do you identify? There are 4 or 3 separate types of form that is used in pay system, and you have to know it. Okay, what is the purpose of it? So if you are giving any type of benefit to your employee, you issue a P11D form. It is known as P11. And you have to know this, by the way, P11D. Later on, we are going to go through that. Don't worry. Again, we are going to go through it. Next, employer can apply to HMRCs to payroll the benefit. Even that also, payroll. How you give cash as a payroll? It comes in the system. Through bank, you pay your employee. Even benefit also. Employee can do this. They can apply to HMRC. Now, the coding notice. In your pay system, there are codes, okay? We don't want to know the detail and on how it is coded and what it means, because in your exam, they will not ask you the detailed process of coding. But just know, okay, there are codes to make life easier, simpler, both for the employer, employee, and the HMRC also. How for the employer? Because they can match the payee, the tax collected, okay, with the particular tax affairs of the individual taxpayer. They can match the payee tax collected with the individual taxpayer. That's why code is used. And also, HMRC issues a payee coding notice or tax code. HMRC issues this code. Otherwise, how will they identify each employee with the pay system? There are so many thousands of employees and their tax are deducted at pay. So how will you know what tax, whether it is correct or not, from that and for which employee? To locate it to the correct employee with the correct pay tax collected, coding is there. Okay, and this coding system enables different amounts of tax to be collected from different taxpayers in varying personal circumstances. Just knowing this is enough. In your textbook, if you have gone through it, there's a whole process. I've not included it, not relevant for your syllabus. But in case if you want to know, some of you are very curious, you can still go and read how that letter they get. Okay, how they give the issue that code. Okay, there's a way of it, a system and all that they follow. Not relevant for us how HMRC gives the code. Now, payment to HMRC. Okay, employers are generally required to make monthly payments of income tax and NICs to HMRCs as follows. So, each month, income tax and NIC will be deducted from the relevant employee. Employee is going to deduct that. Okay. And remember, so this payment to HMRC should not be more than 14 days after the tax month end. Okay, during each tax month. So for this year, okay, and you should know when is the tax month runs, by the way. Tax month runs from 6th day of one month to the 5th of the following month. Always like that. That's why we say 6th of April to 5th of March. Sorry, 5th of April. 6th, 5th, 6th, 5th. So remember this number. Okay, always. So therefore, the payment due date is 19th of each month. Why? If you start from 6, I'm sorry, 5. So 14 plus 5. 6th starting month, 5th. Okay. So if you count 5th of the following month. See, it says not later than 14 days after the tax month end. After the tax month end. So let's say if it is 6th of that month, not at that month, not that month end, after that. So let's say it is 6th of July. Okay, so it's not July, it should be August. Okay, so 5th of August, that is the tax month, no? Add 14 to it, 5 plus 14 becomes 19. That means you should pay within 19th. It should not exceed 19, because they said not later than 14 days after the tax month end. That means after that month, whichever month it is that they have given. So that means your payment due date is 19th of each month. This makes it very easy. Just remember it, 19th of each month. Now, but if employers have 250 plus employees, pay has to be done electronically, and for electronic, the payment date is up to 22nd day of each month. They are giving 3 days extra. Now, HMRC is less than 240. Okay, they have a choice, either electronic or either paper, but mostly because it is electronic, so in your exam use 22nd of each month. Okay, most employees usually pay electronically only. Now, employers whose average monthly payments of PAYE and NICs are less than 1,500. Okay, let's say the total monthly that they are deducting from PAYE and NICs are less than 1,500, then they are allowed to make quarterly rather than monthly payments. That means after every 3 months. And quarterly payments will be 22nd day of the month following this date. 5 July, 5 October, 5 January, 5 April. That means the next month of it, 22nd of that month. For example, it was on 5th April. So 22nd day of the month following. What is the month following April? May. So 22nd of May. By 22nd of May, you have to do the payment. Like that. You have to follow. Okay. So remember this date, 5 July, 5 October, 5 January, 5 April. It will only always be this 4 months. It will not be, they will not say 5 of September. They will not say 5 of November. No question. They will not ask like that. Even if they ask, it will be incorrect only. Only this 4 months. Now, real-time information, RTI for payee. Here, employers submit earnings, income tax, NICs to HMRC electronically. And that also in real time. Okay, which means when or before the employees are paid each week or a month. Maybe this is done before employees are paid or when they are paid, at the moment they are paid. So a year-end summary of all taxes and NICs that has been deducted will be provided with the final real-time information submission for the tax year. They will give you the whole long summary. What is your total tax deducted? What is your total NIC deducted? But even for this, HMRC is going to charge penalty. What is it? Submission of late returns for RTI, real-time information. Okay. And these penalties are charged on a monthly basis, where RTI submission is paid late. But for the first late RTI submission, there is no penalty in the tax year. But for subsequent failures in the same tax year, penalties will be charged. And how is that penalty charged? Based on the number of the employees as follows. Based on this, 1 to 9 employees, 100. 10 to 49, 200. 550 to 249, 300. 250 or more, 400. This is a monthly payment, by the way. Okay. If the submission is more than 3 months late, an additional penalty will be charged on top of this monthly payment. That is 5% of the tax and NICs. Now, so we are done with it. The last section of this lecture is the key payee forms. I told you there will be some letter and number. P11D, what is the purpose? Here we'll explain all the forms, purpose of use and the timing when you have to use it. So if it's P45, remember the purpose. The purpose of P45, so these are the three main forms. P45, the purpose is when an employee leaves. That time this is provided by the employer. If it's P60, gives a year-end summary, and P11D we know summary of benefit. So P45, timing, ongoing use for staffing changes, when your staff changes and all. For that purpose you need P45. P60, provided to the employee by 31st May following the tax year. So for this year, tell me when it be. It will be on 31st May, which year? 2024, correct. Because tax year ends in 5th April 2023. Following the tax year means 2024. So 31st May 2024. By then you have to give the year-end summary and summary of benefits. This is 6th July following the tax year. Okay, provided to HMRC and a copy to the employee. Two people will receive it. The employee and HMRC. And it will be done by 6th July following the tax year. 6th July 2024. You have to know these dates, okay? And the purpose and the form. Now, when an employee leaves, what is the procedure? When an employee joins, what is the procedure? And year-end procedure. So first, when an employee leaves. You know, when an employee leaves, your pay system becomes interrupted, right? Disturbance occurs. Then you have to submit P45 to them. Okay? So that a new employer can carry on making the pay deductions using the appropriate code. So you pay them P45. Okay? So when an employee leaves you, whoever that employee is going to join later on, that new employer can carry on making pay deductions. That pay deduction should not stop unless you are unemployed or something for a time. But immediately you join another company, that new company's employer should be able to carry out deductions, pay deductions from day one. I mean from first month onwards using appropriate code. And cumulative totals from the last employment. From your last employment, they are going to take that cumulative total. Next, an employee can claim a tax repayment. Yes. Employer notifies HMRC by entering the employee's leaving date on the first RTI submission submitted after the employee leaves. The moment employee leaves, it has to be updated in the real-time information. Okay, employee has to notify HMRC that when employees are leaving. Now, when an employee joins, same thing. Okay. So the form P45, it gives information about employee's tax code, what is the pay to date, tax to date, and this will allow the new employer to operate pay for the employee's pay. Same. You should be able to now operate. Where form P45 cannot be produced, employee has to provide sufficient information to enable the employer to work out what tax code to use. Where you are not given P45, you should help your new employer so that they can work out the tax code to use. Without tax code, you cannot deduct pay. You need a tax code so that appropriate amount of tax can be deducted. End of year procedure, P60. Okay, this is a certificate of pay and a tax deducted. This should be done no later than 31st May. Okay, so the employer must send P60 to each employees. Okay, now P60 shows this: employee's national insurance number, employee's name and address, the total earnings for the year, final payee code, total income tax deducted for the year. It's like a summary. And total class 1 NIC for the year. Why class 1 NIC? I don't know whether you can recall or not, in the beginning of this lecture when we went through NIC and all, okay, when we were paying taxes and all, we told that it's not only income tax but even NICs that we have to pay, right? So there we talked about different classes of NIC: class 1, class 1A, class 2, class 4. Okay, so under class 1 NIC, two types are there: one is for employer, one is for employee. Class 1 NIC, employees also pay. Employees pay class 1 NIC. That's why class 1 NIC is totally shown there. Okay, so that's it. Now we are going to go through some questions to test our understanding of the lecture. But that's not it. I request you, please, after the end of this lecture, do go and practice your revision kit solutions. And now you can practice those questions on your ACCA student hub, right? I'm sure going to make a video on it. Okay, soon going to make a video on ACCA student hub, how you can access the resources, textbooks, and lots of questions, quizzes that has been there, not only for this subject, for all the subjects. In fact, ACCA have released their resources. So for right now, let's come back to our question. Question number 5, because 4 questions we have done. The 4 test your understanding I've already covered. Now, and it's going to test the entire lecture that we have covered. So this is about the form and the date. Okay, so Jim receives a salary of 50,000 and company flat, taxable benefit is 5,600. So which form should be Jim's employee use to report the benefit to HMRC and the date? Okay, so there are 2 things you have to match. Okay, first, okay, first match the correct form, then you'll be able to date. At least you should know one. Okay, sometimes it's very confusing. You got confused with the date, even the form, right? So if you know for benefit what form is used, it's easier to ignore A and B, because you know 11D is for benefit. In case you forgot that code, at least if you remember the date, that it is 31st May or 6th July, then you'll be able to eliminate the other 2. That's how it works. I mean, it becomes easier like that. And if you know both, that means it's very easy because you know the answer, right? So for benefit, okay, it's 11D. That means A and B are out. So now we are confused between C and D because both are form 11D benefits, right? But what about the date? For 11D, when is the date? It is 6th July 2023. 6th July. So correct answer is D. Because 31st May, it's for another form, not P11D. That's P16. Okay. Question number 6. So this is about payment on account, and he's a sole trader. That means self-employed. So payment on account was 12,000. This is about the date. Okay, on which date payment on accounts are due for 2022, 2023. Remember, there are 2 payments on account. The third one is the balancing payment. Okay, so you have to know. So tell me, which one? Okay, first eliminate the incorrect ones. Okay, I will eliminate D because it does not start with October. Okay, so D is out. Now A, B and C. So first installment is in Jan, not in July. So C is also out. Now I'm left with A and B. 31st Jan, 31st Jan, but the year is different. So for 2022-23, it starts with 23. So the correct answer is A. 31st Jan 2023 and 31st July 2023. Balancing payment will be 31st Jan 2024. Now, this question, little bit working you have to do, which is there on the next slide. Claudia received a notice to submit a tax return on 20th June and submitted the return on 24th August. Tax due was 470. Assuming no daily penalties are imposed, what is the maximum late filing penalty which can be levied? To recall this, go back and recall what we have gone through penalty for late filing. We have gone through that fixed 100, then we start with 100, you start adding, where 300 was the minimum. That table. There are so many tables, so it's easier to get confused, right? So we are talking about that penalty. So we know fixed is 100 is fixed, okay? And but the question is, what is the maximum that they can go? So for that you have to calculate the number of dates, okay? From 20th June, 24 August 2024, and tax due 470. So now, correct answer is C, 400. We'll see why 400. So if you see, the return for the tax year 2022-23 is due on 31st Jan 2024. First know that, okay? And if you take from 31st Jan 2024 to August, it is on 24th August. So not August whole month we cannot take. Feb, March, April, May, June, July. We cannot take the whole month of August because August 24. But it's not 7 months but more than 6 months, okay? So submission was more than 6 months late. So if it's more than 6 months late, first we take 5% on that 470, that is tax due. So 5% on 470 is less than 300. You cannot go minimum beyond 300. So 300 only you will take. So with that 300 you add 100, the fixed penalty, and it becomes 400. That's why maximum penalty is 400. You should know this working behind, even though in exam you just have to select the right answer. But to select the right answer also you have to do some rough working. I mean, how will you get the right answer otherwise? Okay, now question 8. Here in the tax liability for the previous year was 2022 440, of which 2400 was collected as payee. For the next year, the current year, income tax payable is 26400. So now, ignoring NIC, what is the amount of first payment on account that they should make by 31st Jan 2023? That is the correct date is correct. In respect of his income tax liability, remember, the first payment on account comes from the previous year's relevant amount. So previous year's relevant amount is what you have to calculate. That means it will be 22,440 minus 2,400 and take half of it. So the correct answer is A. This is how they have got previous years, not the current year. Previous year's income tax 22,440 less pay. This amount you divide by 2. So 1020 is the correct answer, which is A. Now we are moving on to question number 9. Which of the following statements is incorrect? Okay. A. Business records. Whenever they say incorrect, okay, for statements, right statements or incorrect, you have to read all the statements, okay? A. Business records relating to tax year do not need to be retained after 31st Jan 2025. Looks like it's incorrect because wherever we have gone through, they have told we have to retain for 5 years or 9 years or more than 1 year only. More than 1-2 years. But this is 31st Jan 2025 and that also is for a business. Okay. What for business? For a self-employed people, how long should we retain? You have to know this. 5 years. 5 years means 31st Jan 2029. So A looks incorrect, but we'll read the others also. Okay. B. A taxpayer who submits a tax return 2 months late may receive a penalty of 100. 2 months late. Correct? It's correct, no? I know you have to tell me. It is correct. Because it's less than 3 months, but more than 1 month. So 100. Third, electronic tax return will be filed by 31st Jan 2024. Yes. Correct. D. Taxpayer who submits his tax return electronically on 13th Jan 2024 has until 31st Jan 2025 to amend his return. Correct. 1 year from the end of the tax year. End of the following the tax year. So, correct answer is A because A is incorrect. Other all are correct. Question number 10. Jared, who does not normally receive a tax return, must notify HMRC of the chargeability. By which date? Everything is in 2023. Okay, but by which date? December 31st and 30th September are out. Now we are in B and C. So the answer is C. B. I'm sorry, I got confused with the date. It's B. 5th October 2023. Okay, because 6 months from the end of the tax year. Tax year is 5th April 2023. 6 months, that means 5th October. Now the last question. If Poland, a taxpayer is not satisfied with the decision made by HMRC, the case can be referred to whom? A. Tax tribunal. B. Another officer of HMRC. C. The Court of Appeal. So is it all of them? Only the first one? Only the second one? Or 1 and 2? The correct answer is D. 1 and 2. You cannot appeal to the Court of Appeal. Only tax tribunal and another officer of HMRC. Okay. So now we are going to summarize this lecture. We have gone through 3 different phases: return, payment, and the payee, the forms and the system. So under return, time limit. Time limit is 31st October for paper return and 31st Jan 2024 for electronic return. And compliance check if it should be done by 12 months. Okay. Less than 12 months of date filed with HMRC. Then for determination has to be done within 3 years of the filing date, and discovery assessment should be done in this 3 years. 4, 6, 20, depending on the taxpayer's behavior. That is whether it's deliberate or concealed, deliberate or not concealed, like that. The table was there. Okay, to understand whether it's 4, 6 and 20. Then we went through penalties. This is for returns only, incorrect returns. We didn't say incorrect payment. Standard penalty for incorrect returns and failure to notify. For 2 things penalties are there. Late filing of tax return and failure to keep records, which is I think up to 3,000. Right? Now, moving on to payment. The due date for payment on account. Payment on account 31st Jan 2023, 31st July 2023, and balancing payment 31st Jan 2024. Jan, July, Jan. Then late payment interest. Interest is calculated from due date to the date paid, and for repayment interest, it is at the later of the 2 days given. But mostly concern is on the late payment interest rather than the repayment interest. Okay. Penalty. If taxes are paid late, you have to pay penalty. So this is how penalties are charged. 5% if greater than 1 month. Further 5% if it takes more 6 months late, and more if it's 12 months, another 5%. Do not apply to payment on account. Remember, this penalty do not apply to payment on account if they are paid late. And for fraudulent or negligent reductions of payment on account. If you are negligently or it's a fraud if you're charging more reduction in payment on account, then penalty you have to be paid. PAYE, the system. Collect tax as income paid. Submit information to HMRC when employee is paid. Then the form P45, P60 and P11D. P45 for leaver, P60 year end summary, P11D benefit. And remember the dates also. Okay. I think P60 is by 31st May, following the end of the tax year. And P11D is, I think it was July or October. Some date was there. I kind of forgot, but go back and revisit. For leavers, they did not give a date. Now, thank you for watching, and before you leave this video, don't forget to subscribe to my channel and do share this content with your friends, your family, whoever is doing ACCA. And also, I will be uploading ATX lecture the moment I am done with all my taxation lecture, which will be in 2 weeks. And then I'll start with my ATX lecture. Okay. But meanwhile, you can go and watch out the syllabus also. It's out there. And watch out my previous lecture, that is lecture 1. And lecture 3 will be soon out, that is the basic income tax computation. How income tax are calculated, the income tax rates, everything will be covered there. So we are being introduced to section B now. From next lecture onwards, will be on income tax purely. We have finished the section A of the syllabus. The first 2 lectures are on section A, that is the UK tax system and the how individuals are charged penalties, interest, how they administrate. The administration process of tax is over. Now we are coming to the main topic, section B, income tax, a very important topic from the point of taxation exam, because your section C of taxation exam test section B purely. So don't forget to subscribe so that you get notified as soon as I upload any new videos. Thank you and take care.